Okay, ladies and gentlemen, welcome to the Solari Report. We have an outstanding guest for you tonight. Tiffany Cianci is someone I've wanted to talk to and interview for quite a while. And Tiffany, thank you so much for joining us on the Solari Report. We really appreciate you. We appreciate your work, and we appreciate your taking the time because this is going to be a major conversation, right?
I am so excited to be here. I've been a huge fan of you for a long time. I've been a huge fan of your work, and I know we have a lot to go over, but I'm excited for every bit of it.
So I'm hoping we can integrate so much of what we've been doing at Solari with what you've been doing, because you've been doing a great job. You also have, I call it the outward bound law degree. So Tiffany had a successful career and then decided to start her own business. You started a gym for children at it was a franchise. You were head of the franchise association,
Yes.
and private equity came along and bought up the the top layer of the company and then started to change the deal. And you ended up in a situation where you and many of the people, other franchisees, were suing, and it's turned into the litigation from hell. Join the litigation from hell club. We're all here.
It's a small club, and none of us are happy to be here, but we're happy to have each other.
Well, that's why I say you have an outward bound degree, law degree. Anyway, but it became a very famous story. And who was it? It was Washington. The Washingtonian wrote it up in a great title, "The Lawsuit from Hell."
Yeah, they did one, and then we were on the cover of the New York Times with like an 8,000 word article too. And I wish we never had to be there. I wish all of the small businesses that I was defending never had to be there. I wish my family
Right.
never had to be there, but I've learned the hard way that the world wasn't quite what I thought it was, and that it's changing faster than I want it to, and that small businesses are eroding faster than our economy can bear. And along that way, I've been able to do a lot of good.
So two things happened. You got shut down by the pandemic. At the same time, private equity was trying to change the game. And so you got hit by the dirty guys on both sides. It was really a squeeze play. And what's been fascinating about your journey is you just keep investigating and figuring out what's really going on. So the subtitle on this interview is "See the Game, Change the Game." And you have really, done a deep dive. And so we're going to talk today about seeing on private equity, see the game, change the game. The most important part, I'm just telling all the audience, the most important part is the last section where we talk about how you use this knowledge to navigate, your economic life and make sure you're not hurt by this game. That's our goal here. But it's very important that you understand the private equity industry, what it is, where it came from, what their tactics are, what their case history is. We're going to go through some case histories. But I will say this, Tiffany continues to deal with very significant litigation and expensive litigation. And so one of the things I'm going to encourage everybody when we start and when we stop, we're going to have your website. You have a beautiful website, and we're going to have all your social media in the commentary. But we will also have your GoFundMe account, and I want to show it right now because it's really important to me. When somebody fights this kind of litigation on behalf of all of us, we really want to support you. And no amount of money is too small. I think the more donors you have, there's really strength in numbers. The more each donation, as far as I'm concerned, is a prayer. So if somebody just gives $1 or $5, it's a prayer, and the major donors see that, and then they'll pile in if they see the numbers. So let's just take a look at your GoFundMe. There you go. I want to see that hit 100,000 by the end of 2026, guys.
That was
Okay.
actually the photo from the cover story in the New York Times.
Oh, great.
That
That's
was
a
a
great.
child I was teaching, a child I've known since she was born, actually. She's still a child I love. I've gone to all of her birthday parties. She's the best kid. And it breaks my heart to see that, because that space is gone now.
Yeah.
It didn't survive.
Okay, so we'll have all of that up, but let's dive in. I want to start by just giving some background on the industry, and we've prepared a series of charts to help you sort of describe the history of this industry. I first came into touch with it when I was on Wall Street because we were in the middle of the KKR takeover of RJR Nabisco, which we're going to touch on later. But that was really the time. That wasn't the true beginning of private equity, but it was really when it sort of came on the stage. So let's talk about the industry and the growth of private equity. So if we could pull up the first chart, what is phenomenal to me, because I've done a lot in my career with the stock market, is to realize that private equity now controls more companies than are present in the public stock market.
That is correct. By a lot, actually. It's a pretty significant number.
It's a very significant number, not in terms of assets under management, but in terms of numbers of companies. So we're looking at a chart that starts in 1995 and goes to 2024. The green line starting at the bottom is PE-owned companies, and then the blue line is publicly traded companies. Now, what's interesting is the publicly traded companies, and this is just U.S. market, is more than 70 trillion now. And if you look at PE-owned companies, it's probably about 6 to 8 trillion in the U.S. It's more globally.
I think we're sitting between 10 and 13% of GDP is private equity
Right.
acquired right now.
Right. But if you look at the number of companies, and one of the things we're really seeing is that this is one of the ways that they're rolling up small business, small practices. I mean, this is really taking over what used to create family wealth. And when you add it to what happened in the pandemic, of course, Wall Street got an injection of $5 trillion, Main Street got shut down, and everybody got squeezed. So it was a field day for people who wanted to roll up companies. Anyway, so let's look at the next chart. So this is the number of employees. So privately equity or funds managed by private equity companies now have almost 14 million employees.
That was last year. I think we're actually approaching 16.2 million this year.
Right, and it's going fast. Okay, next slide. Then here we're looking at value. So, and this is the global numbers, not the US numbers. So if you look at the value of publicly owned companies, they're still much more significant because you don't see the large cap companies owned by private equity. It's much more rolling up the smaller and mid caps. But it's still, you can see it's growing and it's very significant. And I should say the European and Asian private equity is now just really getting going. The US has been dominant. And as private equity has grown, added to it is private credit. And so, especially after the financial crisis, we're seeing a lot more of the lending being done in private credit. And of course, private credit can leverage the private equity. And so the games that can go on, and you've pointed out many of them, are extraordinary. Okay, so some of the really large private equity companies have gone public. And what that means is the company that manages the private equity funds is publicly traded. They're the ones who get the fees. And then they raise funds from institutional investors. And those funds, by and large, are not publicly traded. They're private. And so they're managing private equity, but the holding company, the company that manages them, is publicly traded. And here we're showing that from 2007 on, so basically the financial crisis on, we're showing the performance of some of the big private equity companies. At the top, you have Apollo. Then you have KKR. Then you have, I'm looking at the green one. What's the green one?
That looks like that's either Blackstone or Blackstone, I think.
That's Blackstone. And yeah, we have Blackstone next. And then where's the S&P?
That's the pink line, I believe.
Yeah, it's the red. So there's the S&P in the middle. And so we have both Carlyle and TPG not outperforming the S&P. But if you look at the outperformance, it's extraordinary. And it reminds me, the head of capital markets when I was at Dillon Reed, whenever somebody would outperform by a significant amount, would come roaring out of his office and say, "Tell me why I'm so lucky." Because in a competitive market, that shouldn't be happening. It reminds me, I was just looking at a chart somebody made of the extent to which Nancy Pelosi had outperformed Warren Buffett in the stock market. And it was again quite extraordinary. Okay, we're going to look at the same chart, but from during the going direct period. So the going direct reset began in August of 2019. And so this is August of 2019. to date, and as you can see, the outperformance against the S&P is even stronger.
Yes.
Yeah, so with KKR now stronger during this period than Apollo.
And Carlisle as well.
Yep, yep, yep. Okay, so next chart. So clearly done really well. So let's look at the billionaire list. If you look at the Forbes 500 billionaires and you see, okay, how many of those folks are private equity? It's quite extraordinary. You have, they're not at the top because generally the top is intergenerational pools of capital, that have had more time. But it's extraordinary how many, for an industry that just really took off in the mid 90s, how many billionaires you've created.
Hall Global Management comes in, and they have 6 founders, 3 of whom run the company: Leon Black, Josh Harris, and Mark Rowan. Well, you know where Jeffrey Epstein came from, don't you? Who paid for the flights? Who gave him $200 or $150 million for tax revenue services? Apollo Global Management, Leon Black. You have to know this part. You have to know all these parts. But then you also see how private equity has manipulated retail investors, because they've done it from the start, right? Because it's one thing for companies to go bankrupt. It's one thing for all these employees to lose their jobs and everyone lose money, but everybody wins too. Are you kidding? Canada's invested in this U.S. economy. The number one investor in private equity, period. The Ontario's teacher's pension. Ontario, I forget what it's called. It's like the OTTPP, whatever it's called. But yeah, they're investing into money here on our market in private equity. So when you see messages come across, when you see deals being done, you have to ask yourself, who's on the other side of that deal?
I think during the pandemic, the number I had heard was 500 plus, but yesterday you used another number, 500 and
Yeah. I said there were 551 new billionaires created while 35 million small businesses were shut down.
right. And it was extraordinary because you shut down all the small businesses and you leave the big businesses open. And of course, the market share has to walk across the street. It has no choice.
And beyond that, what it allowed were distressed, like corporate grabs by all of these private equity firms to roll up regional monopolies in entire industries by paying less than these companies otherwise would have been worth in small business
Right.
areas like veterinary care and HVAC, roofing, plumbing.
Right.
All of those were just bought up for pennies on the dollar because they were shut down and they had no other way out.
Right. And two things, both SPACs and some of the money we're going to look at, and the injection by the Fed of the $5 trillion. I mean, it basically funded a shopping budget for these guys to go shopping at the same time the guys they're rolling up are squeezed and in a distressed situation. Thank you, U.S. government. Okay, next chart. And if you look at the concentration by firm of the billionaires by firm, and of course, the winner you can see is Blackstone.
Blackstone always wins. The rest of us always lose.
Anyway, well, the game is not over yet.
No, it is
so
not. No, it is
that is
not. And I
right. We're
think
gonna,
that the entire population is starting to wake up and recognize that they're done spending their money with people that don't give anything back to the economy, to our country. I think people are waking up.
right. So this is we'll get into the model in just a second. Okay, next chart. Okay, so this was a chart that I wanted to put together and show you, and you were kind enough to look at it yesterday, because what we've seen is what I describe as a financial coup. And in the process of that financial coup, between the money that's gone missing from the federal government and the bailouts, from 1998 essentially to 2015, we had $50 trillion pulled out of the federal government one way or another, or the central bank. And then, in addition, during the pandemic, we had a $5 trillion injection.
Yeah.
That's an awful lot of capital. And the question I always get is where did it go? And there are many places it could have gone. But one of the things that's remarkable is if you look at this chart and you compare it to the rise of private equity, particularly after the financial crisis, it's remarkable how much capital they were able to raise. And it's like, I don't remember, have you ever seen those old Pillsbury Dough commercials where they squeeze in the Pillsbury Doughboy and then, he balloons someplace
Yes.
else? So when 50 trillion or $55 trillion leaves a place, it's going to show up someplace. And it's simply remarkable to me how private equity then takes off as the money is disappearing someplace. Anyway, I just want to point that out because there's an enormous, I would say, correlation between money disappearing from the federal government and the rise of the private equity industry. So let's move on. So that's the growth of the private equity industry. I wanted to mention one thing. Let's just do it now. During that period when the money is going missing, there were public policy changes that you mentioned when we first talked that made a tremendous difference to helping the private equity industry really get going and flourish. And maybe we could just mention them quickly. One was Reg D, the Reg D changes. One was the qualified purchasers in 96, and the other, of course, was Glass-Steagall in 98. You want to just say a few words about those?
Yeah, so a lot of people think there are many, many people that like to lay bad financial policy entirely at Reagan's feet. So many people say this was Reagan or trickle down economics. In reality, the expansion of private equity's access to our markets and their ability to hide whatever they're doing on their books from the SEC and any type of auditing or scrutiny has been expanded under every single president since Carter.
Right.
Every single one, including Trump.
Right.
Right. And so what we saw were that there were two very large expansions because back under Carter, the only way a private equity firm could invest was with 35 or fewer investors and literally less than $1 million to start. Okay. And then when we got to the Regulation D Rule 506, which took place under Clinton with a bipartisan Congress, what they did was they took quite a few of the wheels off. They gave them 100 investor limit, and they made it so that they didn't have to register with the SEC as long as they complied with being like a qualified investment company. Okay.
So that meant they could keep everything secret.
Yes, they could keep everything secret, and it was no longer 35 investors. Now it was 100 very wealthy people. All right.
Right.
And then also under Clinton, we got the qualified purchasers under Investment Company Act. That was in 1996. And this means that as long as they chose, they added a section called 3C7, which meant that you could invest private funds and avoid any type of registration or scrutiny as long as they were qualified investors, meaning they had $5 million in assets or an institution had $25 million in assets. And as long as that was the only type of investors they worked with, you could invest with no scrutiny. And at that point, this was only 2 years after Reg D. Now you could have more than 100 investors and you could expand. So now it was more investors, less regulation, and it was only people with ultra high net worth that could benefit. And we knew, like back then, we knew this was bad. We got a warning. I always like to use Pretty Woman. I'm sure you've seen that movie.
Yeah.
Right. That was the public's very first look and warning that private equity was bad. That movie was made as a warning bell for us. When Edward was evil, he was a private equity CEO that went in, bought up huge American ingenuity-driven companies, American excellence companies, broke them off and sold them off for pieces internationally. This was our warning, and he was a bad guy. And his lawyer Stuckey was a bad guy. And he wasn't a good guy until he was reminded that American excellence and building things and building the American dream mattered. And that's when he changed his mind and he was going to go to building big ships and serving America. And then he was the good guy. We knew then this
right.
was
And then Stuckey got very mad because that was a betrayal.
did.
That was a betrayal, right?
So what do you do?
I buy companies.
What kind of companies?
I buy companies that are in financial difficulty.
If they have problems, you must get them for a bargain, huh?
Well, company I'm buying this week, I'm getting with a bargain price of about $1 billion.
$1 billion?
Yes.
Wow. You must be really smart, huh? So you don't actually have $1 billion, huh?
No, I get some of it from banks, investors. It's not an easy thing to do.
And you don't make anything?
No.
And you don't build anything?
No.
So what do you do with the companies once you buy them?
I sell them.
Here, let me do that. You sell them.
Well, I don't sell the whole company. I break it up into pieces, and then I sell that off. It's worth more than the whole.
So it's sort of like stealing cars and selling them for the parts, right?
Yeah, sort of, but legal.
Mm-hmm.
And then under Obama, we saw with with Obama, we took all of the guardrails off. Okay. Under Obama, it was no longer up to 1,000 investors. It was unlimited investors, unlimited amounts of capital. You still had to have a lot of money to play, which meant that it was creating it was beginning the cycle that would start to ultra concentrate wealth and ultra strip mine wealth. Because when you have a lot of money, you can't spend it effectively unless you're buying very large things. And that requires consolidation, right? If there's one billionaire and he wants to eat at $1,000 a plate dinner, he can buy one dinner, right? But if you have 100 millionaires, they can buy 100 dinners. If you have 1,000 millionaires, you can buy 1,000 dinners. You simply cannot rein that money back down into the economy and spend it in a way that stimulates different parts of the economy unless you are consolidating and consolidating and consolidating. And that creates a spiral.
But I want to point something out that I think is really important for people to understand. If I'm not obligated to provide disclosure to the SEC, then I'm going to provide communication to my investors. But that communication is not subject to the standards that filings with the SEC would be subject to. And if I play games or lie, there's no enforcement other than maybe they won't invest with me again if they lose money.
I know we have a lot to cover, but I'd love to build on that because
Okay.
this is why pensions matter so much to private equity. Pension managers historically have underfunded programs, right? That's been the case for about the last 25 years. Pensions are so attracted to private equity because when you put an investment into private equity, normal investments, you have to do quarterly updates that are showing how your assets are performing. And you have to constantly amend your tables. And you have to constantly report that to the commissioners in states that oversee your pension management. But when it comes to big private equity investments, and this is why it's been so bad for pensions, you get to put for the next 10 years the estimated returns they have said you will get on your books for a decade. And for that entire decade, you could say you're getting 45, 50, 60% returns, whatever they've estimated. And usually that means that investment is going to get handed off to the guy that comes after you. It's not going to be your problem. You look like you've got a very shored up pension fund. And for those pensions, it's very desirable because they don't have to disclose exactly how things are performing. And that means that 10 years down the line, when it underperforms, they suddenly get hit with an atom bomb that bankrupts pensioners or bankrupts industries that have to shore up the shortfall.
So somebody just sent me a note, and you're going to help me with this one. The company that just went bust, it was at First Brands. It was an Apollo company, and Apollo was shorting the credit. They knew it was in trouble and was going to go down. They were shorting the credit at the same time they were reporting a full valuation on the stock. So, we'll get into it when we get into returns, but the games that have gone on, because it's not liquid and it's not subject to SEC standards, good luck and good luck with really knowing what it is. It's, you can't believe they got away with this anyway. And then, of course, with Glass-Steagall and then the financial crisis, then you have the ability to start building a private credit. So private equity is equity, but those private equity deals are leveraged with debt. And now when you start to do private credit, you can start to leverage your own deals. And so the funny business that can go on is amazing, particularly if you hold up the values by flipping things back and forth to each other, right?
Yeah, absolutely. And leverage buyouts, I personally find them horrifying. I think they should be illegal. Can you imagine if we could go and buy a car and we went to buy that car and said, but the car is responsible for paying back the debt to buy it? Like the car has to go out and raise the money. The car has to go out and find the way. And while the car is trying to raise the money to pay for itself through taxiing or whatever it's doing, we're going to sell its parking space out from under and then dividend that back to ourselves. We're going to sell its maintenance package we had originally acquired, and we're going to dividend that back to ourselves. We're going to sell the garage it had a parking space in, and we're going to dividend that back.
I would say we're going to sell the carburetors and the wheels.
Absolutely. And at a certain point, we're also going to then lease all of it back to the car, and it has to pay those bills as well. That is a leveraged buyout.
Right.
And nobody that pays normal bills every day could ever foresee that as a reasonable way to engage in finance. It should be criminal, and that is in fact how all of this.
It's a reasonable way to invest in liquidation.
Sure, if that's the goal.
if you want to shut down an economy, it is a reasonable way to do it.
Absolutely.
Because if you're going to shut down an economy, you want to do it profitably. You want to extract the capital, and that's what you do.
Yeah.
Okay, so let's just take quickly a look at investors, because I find this very interesting. So what astonished me, so this is from a recent KKR publication. We'll give them the acknowledgement. So the lead investor in private equity is pension funds, but it's really not pension funds, it's state and local pension funds. And I was amazed when I saw it's a surprisingly small percentage for corporate pension funds.
Correct. That's absolutely true, because corporate pension funds, they're friends with these people, right? Corporate pension funds don't have 10 years to wait. Corporate pension funds try to, and a lot of corporate pension funds are publicly traded companies that have to disclose, right, the value
Right.
of their assets. And if they can't get real-time asset valuations, then they're not going to invest in that mechanism. And so that's why corporate pension funds oftentimes do not invest in private equity.
Right. The other place we've seen a lot of private equity, and it doesn't show as much on these percentages, but some of the real leaders have been foundations and endowments, particularly, Yale, Harvard, and the university endowments. And I've been shocked by how high some of their percentages are. And we'll talk about that because Harvard and Yale are one of the examples. The other thing is private equity has really grown up in North America, and if it's just really starting to happen in Europe and Asia, but it's a much smaller, it's a much smaller market there, but they're growing. The other thing I do want to say is my personal experience running into private equity has almost invariably been highly negative, but I do know asset managers who do know of private equity firms they like and think are excellent and do real business. So I would just mention that they apparently do exist, and I think that's your experience as well.
Yeah.
Right.
I wish I could say I ever have anything good to say about it. I have a few shining examples of places where it's been used well, like when Bain Capital saved Domino's. But for the most part, by and large, every experience that's ever relayed to me ends up having pretty catastrophic outcomes.
Right. Well, it's an extraction model,
Yes.
and we'll get into the model in a second. But one of the state pension funds we're going to talk about is Oregon. And this is a story you put me onto, which is unbelievable. It's called How the Managers of Oregon's $100 billion Pension Fund Ignored Expert Guidance and Lost Big. And of course, this is about a pension fund that got really overconcentrated in private equity. But let's go ahead and look at the chart now. Let's pull up a chart from this article, how the Oregon Public Employees Retirement Fund lost out on more than $1 billion last year. This is heartbreaking. This
Really
is a
is.
heartbreaking story. The picture at the top of the article is of the art teacher who lost her job
Yeah.
because they had to, the system is set up that if they drop on their actuarial performance, then the local governments, and schools or, whatever have to pony up more money, and suddenly their budgets get wrecked. So describe to us what happened in Oregon.
So they had brought in a new investment treasuries manager, and they had a standard policy in place for a diversified approach, very similar to the one that Yale pioneered with Swenson, right? He was the pioneer that had diversified investment as a strategy that they were using for the endowments at all of the universities. This man had a diversified recommendation, and he chose to ignore it, despite specific board member directives. They said they didn't want him investing as much in private equity as he was, and that they were very uncomfortable with the investment strategy, and that they wanted him to go back to bonds, stocks, and he ignored them. And unfortunately, it has had catastrophic consequences. The catastrophic, when I say catastrophic, $1.4 billion in shortfall. But what that equates to is having to let go of or not rehire 14,000 teachers in the state of Oregon. And
Wow.
as a result, they have this massive shortfall because his investment ended up only performing at 4.2% during the same time frame that the stock market saw an almost 36% performance.
So here's what's interesting. If you go look at it year by year by year, if he had obeyed the recommendations and what the board wanted in terms of percentages, they would have been far more protected. There's a reason you have portfolio allocations.
Yes.
And, nobody, you never bet the ranch on prophecy or, a particular, and there's a reason it's diversified and you have portfolio allocations. And if he had enough time once they set the allocation to adjust and refuse to do it. It's quite extraordinary.
It appears he thought he had inside knowledge, and honestly, he may have been following CalPERS. CalPERS had a similar problem in the last decade, and very recently, just over the last 2 years, they've reined in all of their private equity investment because they got so over leveraged into private equity. And so CalPERS in California is another example of that. He may have been following their strategy and thought that he was going to do better. I couldn't say, but it's horrifying for the children and the families, and especially I'm going to say the special education children of Oregon, because that's where they've had to make significant cuts, because those are some of the more expensive programs, expensive teachers
Right.
to have on staff. And they're having to cut all their arts as well.
So you know the story. The head of CalPERS in 1997 told me, I presented our plan when I ran an investment bank in Washington called Hamilton Securities, and we had done tremendous simulation of federal credit and were able to show them how we could re-engineer the federal budget and change the investment in place in a way that could produce huge amounts of increased equity and make the pension funds a fortune, helping them deal with the boomers' retirements. And the head of CalPERS looked at me and he said, "You don't understand. It's too late. They've given up on the country. They're moving all the money out starting in the fall." And I thought what he meant was we're reallocating equity to the emerging markets. I didn't realize, that the move was anywhere near that big. And I have two questions now looking at private equity. Is moving all the money out of the country starting in the fall include extracting enormous amounts of capital from Red Lobster and Joanna's and all these different businesses that have been bankrupted by private equity? Is that part of the move to extract capital and move it elsewhere? So that's question number one. But question number two is, after that, CalPERS lost a fortune in the mortgage markets between then and the financial crisis. And I know from my meeting that they knew. They knew, and they certainly would have known about the extent of the mortgage collateral fraud, which says to me, who's making the decisions at pension funds? I mean, they are not acting in the best fiduciary interest of their beneficiaries. They are acting on the basis of what the insiders tell them to do. And that's a complete violation of the law.
And it's interesting. Your meeting was 96, right?
97.
97.
April
So this is
97.
the exact same time that we're seeing Reg D and we're seeing the qualified purchasers getting done. It's the same time we're seeing the repeal of Glass-Steagall. It's the same time we're seeing the warning from the movie Pretty Woman. But it's also the same time that we began pitching the idea of moving people from pensions to 401ks that
Right.
gave voting rights to the 401k managers, a la BlackRock, right? It's the
Right.
exact same time frame, which
Right.
BlackRock was ultimately spun off of Blackstone.
Right.
They are very, very close bedfellows, and
Right.
they have a stranglehold on our government.
So I had lots of dealings with BlackRock when I was in the administration. I'm happy to tell you the story sometime. But one of the things that happened was Larry Fink called me screaming and threatened that he was going to write a letter complaining about me. And I said, "Please, Larry, be my guest," because I thought, what could be better for your brand than have Larry Fink on the record in a letter? He was complaining that I gave precedent to the taxpayers above him.
Oh my goodness, say it isn't so. A lot
That's
of
a crime.
people,
That's a crime.
a lot of people like to say that they believe, like, there's still these dyed in the wool, like these people that believe that we can vote our way out of this problem with the two-party system that we're dealing with right now. There's so many people that say this to me. Our government's playing 4G chess. They're going to get us out of this. They're paying attention. The economy is going to get better. I am married to a federal attorney, and very few people believe me when I tell them the stranglehold that BlackRock has on the US government. But right now, just as an example of one of the reasons we know that our US government is never, ever, ever going to work against BlackRock is because for the last 15 years, and certainly right now, every single former federal employee, from the president all the way down to the janitors at the US House, every federal employee at the FBI, every federal employee at the US Treasury, their entire pension is invested 81% with BlackRock and 19% with State Street.
Right.
Every US president going back for the last 2 decades has had members of BlackRock's board or former members on their economic advisory council. Biden's senior economic advisor was a BlackRock board member. So we have this like fiscal stranglehold on this company where if they vote against them, if they do anything or pass a law against BlackRock, they're hurting their own employees. They're hurting their own pension. They're hurting their own future. And I don't think that should be allowed.
It's worse than that because here's the big problem if you're the president. So if we made you president tomorrow, you have a $6 trillion a year budget, okay? And you're getting revenues of $4 trillion from taxes and various sources. And then you're borrowing $2 trillion. And the way the borrowing is set up is it goes through the New York Fed.
Yeah.
And the New York Fed has your bank account. So you are 100% dependent on the central bank. Okay. And so the people who run and control and own the central banks basically control you because everybody in America wants their check. And if you try and say, look, we're going to cut back by a third, they're going to say, or 25%, they're going to say no. So I never forget that one of my favorite quotes is I had a senator in Idaho, a state senator, say to me, every year we send $1 to Washington and we get $1.19 back. And every time I try and enforce the Constitution, my constituents say, I'd rather have the 19 cents. Right? So that's why, there are many solutions, but they require you shifting the money. It's not just voting. You vote in the marketplace every day with your time and your money, and you got to shift that vote too. Anyway, so let's talk about the business model and returns, because the fundamental problem in this industry is the business model for the most part, not everyone, but for the most part, is an extraction model, and that's with leverage buyouts. So what you do is well, why don't you describe it? Why don't you describe the fundamental model and how it works?
So I like to say that when you're engaging with a company that is more pirate-like in its private equity nature, I mean, your mom giving you money is technically private equity, but that's not evil, right? There are some
Right.
ethical firms out there that invest. It's very hard for small businesses to get investment. But when we're talking about the pirate-like private equity that we're experiencing, you have a system of what can only be described as fiscal extraction with hot potato, right? You have an investment. You're going to buy something through leverage. You're going to buy, let's say you want to buy, I don't know, Catherine's Tire Center, right?
Right.
And Catherine's Tire Center is worth $10 million. And you think you can get more out of that tire center. You can get a lot more out of that tire center. So you're going to come in and you're going to borrow a bunch of money from pensions and banks. It's not going to be your money. You're going to put up $2 million of your money and you're going to borrow 98 million from somebody else.
And it's not going to be your money. It's going to be the money you've got in your fund.
Yes, it's going to be the money in your fund.
So I'm a KKR or Carlyle. I'm publicly traded, and that's the management company. The management company manages. I've got a fund that I raised from a state local pension fund, and I'm going to use that money to put in the $2 million, and then I'm going to borrow
the other 98 million. Absolutely. And what's important to recognize in this as well is that every one of those funds, each of these firms has multiple funds moving at a time. And each one of those funds has a shelf life, somewhere from 7 to 12 years. I think they're starting to extend them because they're realizing exiting isn't really working anymore. But for the most part, the standard in the industry was 10 years. So that means that I have 10 years to take the money of my investors and my own money, if there's any of your own money, which there usually isn't. And I have to put it to work and extract as much wealth out of our economy as I can in that 10 years, close out that fund, pay everybody, and move on. Now, if I want to buy Catherine's Tire Center, I'm going to borrow most of the money to do that. And I'm going to buy Catherine's Tire Center. Now, let's say Catherine's Tire Center had a really amazing infrastructure that she had built up. Okay, let's say she had her own drivers, she had her own warehousing, she had her own fleet of trucks, she had her own backstock to survive economic downturn, and she owned the land all of her stores were built on. I see immense opportunity for myself with very little concern for what that means for the communities, okay? So after I get my hands on Catherine's Tire Center, I'm going to borrow that 98 million. I'm not going to owe it back. I'm never going to owe that money back. Catherine's Tire Center is going to owe that money back.
Right.
I have no liability whatsoever, even though I get all of the decision-making capabilities. Now, the first thing I'm going to do for Catherine's Tire Center is I'm going to set up a management agreement.
I have the decision making but it's layered through LLCs and other funds, so I'm not legally liable for the
Correct.
decisions.
You have separate and apart enterprise liability, which means Catherine's Tire Center, all of that leverage is foisted upon her
Right.
center to repay, even though I'm the one that made the decision. My fund is the one that created it. My fund is the one that borrowed it. My fund is the one that convinced the bank. I have no liability whatsoever in getting that money repaid to the banks. And the banks don't really care. This is very important. The banks don't care because they're loaning that 98 million in adjustable rate or floating rate debt. And they're going to repackage it and sell it off as CLOs or collateralized loan obligations, just like in the housing crisis. They're going to rebundle this as AAA CLOs, and they're going to sell that off through other mechanisms. So even the bank carries no
To your
liability.
pension funds.
To your
Here we
pension
go with
funds.
pension funds again.
So
Right.
even the bank has no risk or liability here because they're only going to sit on their books for 2 or 3 weeks. So
Right.
Catherine's Tire Center now has been acquired. Well, the first thing I'm going to do is set up a management agreement that says that Catherine's Tire Center now owes me $10 million a year for my management and oversight advice. They might also have a finance agreement that says that I'm going to handle their HR, or it might be an agreement that says I'm going to send in people to advise, and each one of them gets paid
Right. And those are
$100,000 a year.
contracts. Those are contracts for other companies I own.
Correct. Absolutely. And we're going to talk about a lot of different companies I own, because first I set up that agreement, which means I'm already making 10 million of my 100 million back in the first quarter, just like that. Second thing I'm going to do is I'm going to look to my left and my right and see if I have any of my funds invested in real estate investment trusts. And if I do, I'm very quickly going to go in and advise my tire center board to sell all of the land under every one of our stores to the real estate investment trust I already own or I'm already affiliated with for very low, right? We're going to sell that for cheap. And then we're going to rent it back to Catherine's Tire Center all across the United States. So Catherine's Tire Center now might have a new $30 million a year in leaseholds.
Well, but here's the thing. I inject all that money into Catherine's Tire Centers and then I dividend up to me.
Correct.
So I put in 2 million of equity, but now how much equity?
At this point, you've pulled out 40 million.
Right.
And we're at quarter two. We are at quarter two. And Catherine's Tire Center now has no real estate assets left. That was something they could rely on or borrow against an economic downturn. So they now have leases they're paying for they never had, management fees they've never had. And next, I'm going to look to the fleet of trucks. I'm going to see if I have anybody I'm invested with, or I have a friend that I'm invested with that would like to buy my fleet of trucks.
Right.
And I'm going to sell that again for low cost. And I'm not going to use that money to pay down the debt I put on Catherine's Tire Center. What I'm going to do is I'm going to dividend that back to myself. And now Catherine's Tire Center is leasing back the trucks she owned 1 week ago.
Right.
And we're spending another 10 million a year. Okay. And now at this point, I've gotten 60 million of mine back and we're in quarter three.
Right.
Then I'm going to tighten our belt because you know what? We have a lot of bills now. So we're going to cut our staffing. We're going to consolidate with any other companies I've acquired, and we're going to start fixing our prices. We're going to raise our prices. We're going to reduce our quality. And then from there, we're going to continue this cycle. The next thing we might do is we might liquidate our warehouses, and then we might sell all of our back stock to a liquidator. All of this getting dividended back to the private equity firm, never paying down the debt that I foisted upon the tire center. And the tire center still owes all this money, and interest rates just went up. Now, a lot of people might think this kind of loan might be 2% or 3%, that they're getting very specialized loans. Right now in America, the average repayment rate that they're giving on private equity is between 9 and 14% at this moment. And if it's a distressed asset, 21%.
So I would just like to point out the history of central banking is that whenever a society approves, legalizes usury, it's just a matter of time until they fail.
Yes.
Okay. So that's what we're talking. We're talking about, now if you look at credit cards, the average is 17% and they go up to 35+%. So, it could be worse if you're doing it on your credit card, but this is not sustainable business.
It can't be sustainable. And here's the reason. These funds aren't holding these businesses for 10 or 12 years. They don't need it to be successful long term. What they need to do is identify how much they can squeeze out of it very, very quickly, and then they're going to flip it in under 3 years. Okay.
Right.
The average just a year and
If they can.
If they can.
We've got a lot now that can't. So
but for the last decade, they were flipping them like Pokemon cards, right?
Right.
And so what you have is a system where when they're selling off all of the assets of Catherine's Tire Center, despite Catherine's Tire Center having all this debt, they'll hold the assets with the tire center for about a month, just long enough to get a revaluation with all that cash liquidity. And then they will borrow more debt and stick it on top of the tire center and dividend that back to themselves. So they're made whole in under a year, literally under a
Right.
year. And then we're going to begin the process of trying to figure out how far we can take it. Now, when private equity first started doing this, it was very common for them to actually look to take it back to IPO. That was their exit strategy.
Right.
It wasn't necessarily to strip mine everything out. And my favorite example of that is Bain Capital's acquisition of Domino's, right? When they did that, they had a 10 to 14 year hold strategy. And that meant they needed franchisees to be successful for 10 to 14 years for them to get the exit that they planned for.
Right.
And it worked. They created a cooperative in their food resources that passed along savings to their franchisees. And it started dividending back whatever savings they could generate for them through the economies of scale that they were buying. They got new chefs. They did an amazing marketing campaign. They brought in new blood because they needed a 14-year strategy.
Right.
And it worked. It
Right.
saved Domino's. Now you can flash forward and look at what Bain Capital did to Toys R Us and see that changed.
Right.
That was not the strategy that stuck.
Right.
Okay. Instead, what they did with Toys R Us is they sold all the real estate, they sold all the trucks, they sold all the warehouses, they cut all the staff, they got rid of the stores, and they made it so that there was literally nothing left.
Right. But there's something else.
Yeah.
They stuck the pension fund
Yes.
to the Pension Benefit Guarantee Corporation,
Yes.
and they stuck the unemployment payments to the employees. I mean, they stuck the taxpayer with enormous bills.
They Texas two-stepped out of it.
Right.
That's what they did.
Right.
They offloaded it to a shell corporation where all the debt was held in one place and all the assets were held in another, and it worked horrifyingly well. And then they blamed it on Amazon, which was never true. It's just like Joann's right now. Joann's just went out of business and they made it say, oh, it's just crafting. No, 97% of Joann's stores were profitable. 97%. That's an astronomical number. 97%. Their sales base had doubled.
Right.
Because of COVID. People got hobbies. It was doing very well, and they stacked them with billions of dollars of debt. And they sold all their land, and they had huge leases now. They were never going to survive.
Right. And that debt was adjustable rate. So as
Yes.
interest rates rose, no endurance.
And we're about to watch it with Michael's. And at the end of this game of Monopoly, Hobby Lobby will be the last one standing.
Good Lord.
Yep.
Has private equity got its straw into Michael's yet?
Yeah, they own it right now. They just took it back.
Okay, but they don't have their straw into Hobby Lobby.
No, Hobby Lobby is family and private owned. And I literally hold it out as this shining example of if we're actually going to allow this to continue, then we need companies like Hobby Lobby to be the winners in the end, because Hobby Lobby runs on Christian values. And that's not why they're going to win. They're going to win because they don't believe in usury. So they don't borrow money.
Right.
They only take on debt they can pay back within 1 quarter with cash liquidity. They've expanded slowly, steadily, and they've built this enormous footprint and amazing infrastructure with no debt.
Right.
And that's why in this game of Monopoly at the craft stores, after A.C. Moore, Dick Blick, we had, what was it, Hanson's Fabrics? I don't remember. Hancock Fabrics. We have Joann's now. They've all been rolled up, acquired, consolidated. The quality is terrible, and we're down to 2 stores. There's nothing else left.
Okay, so let's keep going on the extraction model. So one of the things that is happening that makes this so attractive for the private equity firms is they get the benefit of carried interest, which is outrageous.
Yes.
This is totally outrageous. And once again, we had a tax bill go through Congress, and once again, the administration protected carried interest, even though we have skyrocketing deficits, and this is outrageous. So explain to us what carried interest is.
So the carried interest loophole is something that people often campaign on promising to close. It's a tax mechanism that allows you to carry interest as a payment to not pay yourself out, and you get the benefit of a very low tax rate. I think it's under like 15%.
So if I do a deal with a pension fund and I say, okay, we're starting this fund and I get 20% of the profits, that's my carried interest, and I get an abnormally low capital gains rate on that portion of my return.
I think you have to understand the 2 and 20 model to really like understand that, which is how private equity
Right.
firms get paid and why it's not valuable for most of us to invest with them ever. They operate under something called a 2 and 20 model, which means that they get paid 2% of the total amount that they're managing for you. And then they also get 20% of your gains. And so, the way that they get that and they carry it on their books, it allows them to keep that money flowing without having to pay taxes as if it's been realized.
Right.
On top of that, they're exploiting a loophole in our tax system to pay dramatically low taxes on their income, because of course. It's called the carried interest loophole. Fund managers are paid most of their salary in the form of carried interest in the fund's profits. When held for at least 3 years, that carried interest is taxed at 15% for income between $100,000 and $600,000 and 20% on income over $600,000. Regular income of over $600,000 is taxed at 37%. So not only are they ruining our communities and our jobs, they're also getting a major tax subsidy in the form of this carried interest loophole.
And it's really horrifying. And all of these people have run on closing it. Biden ran on closing it, and he almost did in 21. They had the votes to close the carried interest loophole, and Kristen Sinema took very large donations from private equity firms, took a bunch of private meetings, and they promised they would make Arizona the private equity seat for America. And they did, by the way, and she crossed and voted against it. Then Trump came into office in this term and said he was closing the carried interest loophole. And instead, after
He
promising
lied.
it over and over again, he instead used it to extract a ton of donations from private equity firms. And then he turned away from it. And then on top of that, gave them a $12 trillion bailout as as their profitability started to dwindle by giving them access to our 401ks and retirement funds.
Right. So we're going to talk about that later because that is frightening.
Yeah.
Absolutely frightening. Okay. So another thing that is important to understand about the model is the long lockup time, which we mentioned earlier, and the ability when you do have some limited redemption power to freeze withdrawals. And that gives you, when you combine that with not being under strict disclosure obligations, you can imagine the funny business that goes on. So tell us a little bit about that.
So one of the things that makes it so attractive to pensions, which we talked about, is the fact that your money is stuck for a decade on average, right? Once you put money into a private equity fund that is a specific purpose fund, it's stuck there 7 to 12 years. Usually 10 is
Right.
the average. And while it's stuck there, they don't have to make any real disclosures to you. And there's no guarantee or auditing mechanism to see what they're actually disclosing is true. Now, we've seen this abused already because your money is stuck. We've seen this abused very recently by Blackstone. They had the Bright Fund, the BREIT fund, which was a fund that was a limited purpose private equity fund that they allowed lesser institutional investors and lower net worth investors into, where if you only had $1 or $2 million in liquidity, you were allowed to invest in this fund. And it was all commercial real estate. Well, in the aftermath of COVID, commercial real estate saw huge losses in valuation because people were working from home. And all of the other funds in the United States that were publicly disclosed were losing value pretty exponentially, dropping by 30 to 50%. But Blackstone, for some reason, kept reporting that their Bright Fund had gone up in value, and people started to question it. The Financial Times was questioning it, Barron's was questioning it, Reuters was questioning it, and people got very skittish because they felt they were being lied to, and investors in this fund were allowed to withdraw on the quarter. And what happened was when withdrawal requests exceeded 5% of the fund, they froze withdrawals, and then they had to go out and find capital to come in because they couldn't meet the withdrawal requests, and they were manipulating data.
The problem with reporting high valuations is then you have to redeem at that price.
Correct.
So they were putting themselves in their own squeeze.
Correct. But they
Yep.
were allowed to freeze their squeeze, right? And you
Right.
should not be able to do that, but we have no oversight. We don't have any governance.
So this is why, I mean, I love liquidity. I love liquidity because, when you every day you can look at what the price is, and markets can be managed and rigged and influenced, but there is a price at which you can buy and sell. So I love liquidity. I wanted to mention A Bad Man's Guide to Private Equity and Pensions by Elizabeth Lewis in 2015. So I was trying to look up as many of the scholarly studies as I could. So this is an old one, and because there's been a lot of shenanigans since. But in her survey, she found, when was it? She found 1.6 billion in pension fund bills dumped on the Pension Benefit Corporation from 51 companies abandoned by pension plans in bankruptcy at the behest of private equity firms as of that date.
I wish I could say there's ever a number that shocks me. There's not. There's
Oh,
not.
I think it's much worse now. I haven't
agree
gotten a
with
new
you.
number from the pension benefit. But stripping a company and then putting it into bankruptcy, if you look at the statistics of how many private equity companies go bankrupt versus, publicly traded or, just private companies, I mean, it's clearly a pattern and it's clearly something they're using. And we see them also go into bankruptcy, get rid of the pension fund, and then come back out again.
Yeah.
So it's just a way of stripping off and walking away from your pension fund obligations.
And another thing that we don't see, and I'm gonna squeeze this in there because the free market should be responding to this, but it's not, is we don't see that because in all of the terms and conditions of all of those participants, they have signed arbitration agreements, so we never see the lawsuits that follow, ever.
Right.
We never do.
And
We
what
never
about
get
the
made whole.
non-disclosures?
Yeah.
So a lot of the investors sign non-disclosure agreements.
Yes, absolutely.
Now, a public pension fund has to admit their losses when they take
Yeah.
the loss. But I would expect that the NDAs are protecting a lot of these firms and the arbitration. So let's move into tactics. And of course, my favorite tactic is the arbitration. So tell us, you are an expert in arbitration and forced arbitration. So tell us about the arbitration game.
So arbitration is a secret court system that exists in the United States and other countries, but primarily in the United States, that convinces people that they're going to what they would describe as an alternative dispute resolution process. They tell people it's cheaper than court, it's faster than court, it's better for you because if you go to court, the lawyers are the only ones that win. Arbitration was founded under the Federal Arbitration Act, and it was done, I actually think, for a very reasonable reason. It was started largely because of maritime and telecom law. You had these giant firms that were litigating these very complex legal issues that very few judges had any experience with. And what would happen is they would go to court over a merger or something, and they would spend $30 million educating the judge on the law before they ever got a hearing heard. And so what they did was they lobbied for the creation of the Federal Arbitration Act that said that these two firms on equal financial footing could go and seek out a judge for an alternative dispute resolution that would be recognized by the courts as binding. And that's where it came from. Now, unfortunately, the Federal Arbitration Act was very badly written, and it was written very vaguely and very vastly in a way that allowed it to be expanded and exploited, and no one ever stops them. So what's happened is we've had this industry rise up through this alternative dispute resolution arbitration that has created a cartel or a monopoly, specifically with a brand called the American Arbitration Association that oversees 93 to 95% of all of these cases. Now, originally it was for these big companies that had equal footing and they could afford to go in there and fight, right? They could do that. But it's been expanded over and over again by companies seeking to hold people to arbitration agreements they never even saw they signed. They certainly never negotiated on.
It's buried in the contract. It's buried in the that's why you've got to read these things very carefully. So I told you one of my favorite documentaries is Hot Coffee.
Yes.
And it's about the effort to go state by state and do tort reform so that you can systematically deny companies, who are concerned about liability for products and services can systematically contractually deny people access to the courts and force them into arbitration.
Now, a lot of folks might think that's okay if it costs less and it's faster. What nobody knows is that the arbitration system is funded entirely by corporations. These judges don't even have to be judges, and the judges do not have to follow the law. They can write their own law. They can make up their own law. And because the system is funded by corporations paying these judges $20, $30, $50,000 a week for their time, and these corporations become their repeat customers, the judges rule in favor of corporations 97% of the time.
Now, my understanding, they don't have to explain their decision, do they?
No, in my case, I was there for a 2-week trial, and the most important piece should have required dozens of pages of legal analysis. I got one paragraph explaining why I lost on something.
Right.
One paragraph. There was no legal analysis. It would not be able to stand up in a court of law, except that the Federal Arbitration Act says all courts must recognize the decision, no matter how insane it is, and they must hold people to it.
An 81-year-old woman has been awarded $2.9 million after she sued McDonald's, claiming their coffee was too hot.
Stella Liebeck spilled just 8 ounces of coffee, but she attracted a flood of attention. The jury's awards set off a media frenzy and became a rallying cry for those who believed our legal system had run amok.
I think it's absurd.
But as her story cycled through newspaper headlines, talk show storylines, and late-night punchlines, one thing was lost: the facts.
The public perception of it is Stella Liebeck won a lottery. She bought the coffee, she spilled it on herself, and now look, she's a millionaire. When, of course, the facts are much more complicated than that.
She was burned over 16% of her body. 6% of the burns were 3rd degree. She was in the hospital for a week.
Medical bills were $10,000, so Stella reached out to McDonald's and asked to be reimbursed.
And the response from McDonald's was an offer of $800.
They based the amount on the revenue from 2 days of coffee sales, $2.7 million. The size of the award got the media's attention, but it overshadowed the rest of the story. Details of the case and the facts related to how the jury made its decision went mostly unreported.
It's probably one of the most sensational, high-profile tort cases of the last 20 years. So when tort reform comes up, most people say, oh, you're sure the McDonald's case.
Republican lawmakers crafting the Contract with America seized the moment. They tapped into public outrage over frivolous lawsuits to promote the Common Sense Legal Reform Act. Liebeck's case became Exhibit A.
If a lady goes through a fast food restaurant, puts coffee in her lap, burns her legs, and sues and gets a big settlement, that in and of itself is enough to tell you why we need to have tort reform.
We started with the story of hot coffee. Lay out why you're doing this.
There's been a huge public relations campaign over the last 25 years to convince the public that we have too many frivolous lawsuits, that we have out-of-control juries, that we need to change our civil justice system, which is our 3rd branch of government, where an average person can go head-to-head with the rich and powerful, with corporations. And people have a completely distorted view of our civil justice system because of this public relations campaign. And I wanted to tell the truth. I wanted people to understand that they were giving up their constitutional rights every day to access the courts, and they didn't even know they were doing it.
Explain tort. What do you mean by tort?
So a tort is a civil wrong. We have a criminal justice system and a civil justice system. We all know what the criminal justice system is. But when people are injured by a defective product, or if they've had, been the victim of a medical negligence, they have the right to go into a court system and bring a case against the person or the entity, the corporation that harmed them. Those kinds of injuries are called torts. They're civil harms. So Jamie Lee Jones was 19 years old. She lived in Houston, Texas, and Halliburton is huge in Houston. I mean, it's like the biggest corporation down there. And she went to work for Halliburton in their IT department. And when she was hired, she was asked to sign an employment contract. What she didn't know was that embedded in the employment contract is something called a mandatory arbitration clause.
Yes.
These clauses are in all of our contracts now. They're in our cell phone contracts, our credit card contracts. If you get a car loan, a mortgage, some doctors are now putting them in their consent clauses. What they are is they are literally contracts where people are asked to sign. Oftentimes, they don't even have a choice to sign. If you get a credit card, for example, and you use it, you've agreed to mandatory arbitration. People don't even know what it means because it's something, no dispute has happened yet. But if you have agreed to that, and then you have a dispute with the company or the entity, you have waived your right to the court system. And people say, well, why should I care about that? Well, why you should care is because the company that you are having the dispute with, once you've signed that, they pick the decision maker, the arbitrator. They pay for the decision maker. The decision maker doesn't have to give a reason why they've come up with the decision. It's completely secretive, and there's no right to appeal. And what everyone is doing these days is they are literally voluntarily giving up their right to access the court system, and they don't even know they're doing it.
And so you have this system that has been fully corrupted and exploited by monopolistic control. It is a cartel that always and only supports the corporations. And people are being held to arbitration agreements in numbers nobody would believe.
Right. And you end up having to pay for the arbitration.
Yeah, absolutely.
Right.
And that means my judge in my arbitration was almost $27,000 a week. My arbitration went on for a year and a half. $27,000, just do the math, okay? Right? And this is if you want to keep fighting, because if you don't have money in your account, you don't get to go before the judge.
Right.
And they have unlimited money in their account. But people don't realize how many of these agreements they've signed. If you have a phone in your hand, you've probably signed 30.
Right.
Okay, one for every, right? If you've bought a new washer and dryer, this is how liberal it's gotten now.
Right.
They can put the arbitration agreement in the warranty paperwork in the box, and as soon as you plug it in, you're held to it.
Right.
You want to buy a ticket from Ticketmaster? Arbitration. You want to get on a flight? Arbitration. You want to take your kid to a birthday party at a trampoline park and you sign them in at the front? Confidentiality, NDA, arbitration.
Right.
Your kid dies in that theme park? Arbitration.
Right.
And they're going to win 97% of the time.
Right.
Whereas if you got to court with a lawyer, you're looking at 55% in your favor.
Right.
It's the way that corporations have found a way to so grossly bastardize the free market system to hide all of their terrible conduct from all of the eyes that could respond and demand market reform, demand changes, or simply put them out of business through boycotts and protests.
Well, it's part of the model, because if you're operating, and we're going to get into some of the other tactics, but if you're using a lot of shenanigans and tactics, then on one hand, you're doing sort of unethical or illegal practices. And so you need a way to come in behind and make sure you can't be held liable.
Exactly.
So I don't know if you've been following it, but the pesticide manufacturers are now this close to getting complete liability. Thank you, Trump administration in several states.
So I've actually been speaking about this on InfoWars regularly because this is something I follow very closely. And I don't know if you saw, but just last week, the DOJ had their senior counsel send a letter to the Supreme Court asking that they move to ban all litigation on pesticides for any pesticide that has been approved by the EPA, because if the EPA says it's safe, it should be unlitigatable, because they've never gotten science wrong ever at an agency in the US government, ever. And so once the EPA has approved it, they are protected forever. And you can never sue them, even if it finds out it causes.
So here's the thing. If I was the attorney general, I would resign before I would send that letter.
You would think so, wouldn't you?
I would.
But the Solicitor General sent that letter.
Wow.
And this is after they've got ALEC, the American Legislative Exchange Council, going state to state right now through the Dakotas and through the Carolinas to try to get pesticide immunity passed for the protection of the farmers, who, by the way, have the highest Hodgkin's lymphoma rate of any profession in the world.
So we did a show with the microtoxologist who helped stop it in Tennessee and North Carolina. She came up on her own dime and testified in Tennessee and North Carolina and literally got it stopped. And so we had her on the show that we do on CHD TV, Financial Rebellion. And we get to the end, and she's very scientific, very professional, very calm. We get to the end, and she said she's discussing the impact of what she thinks will happen to fertility if the liability shield is created and the pesticide companies do what they say they're going to do. And she says very quietly, you have to understand that the impact on fertility will be such that I consider this an extinction level event.
You know, you have to, I don't know if you're aware of this, but right now the Senate just added full pesticide immunity and the inability of the EPA to enforce its own requirements into the 2026 appropriations bill. That's a must pass. And if they're able to do it, then that's it. Now, actually, I don't agree with them on a lot of things, but Senator Cory Booker has just introduced the Pesticide Accountability Act, and it's right now the only hope we actually have to stop this.
God bless him.
Yeah, so he just introduced that, but he can't find a co-sponsor. No one will co-sponsor it, even though we have this MAHA agenda. We put a bunch of agrochemical lobbyists in charge of the EPA to undermine everything on the MAHA agenda that's coming from HHS.
So when we get to health, we're gonna now. Can I finish doing the business model and then we take a break?
Yeah, absolutely.
Are you good for another? Okay. So let's go through some of the other tactics. The legal shenanigans are endless, as you know, okay, including the litigation. But I once had a litigator tell me the number one firm that lies the most of any firm they dealt with. And when I was doing a search for who has the most private equity legal business, who should pop up as number one but that firm? I was laughing my head off, but
Do you feel comfortable saying who it was?
I would rather not.
Okay.
So I don't want to get him in trouble. So
Okay.
but
Well, I'll tell you, Seidler is the most litigious firm I've seen.
really,
Not because of them, but
there's
the
a
companies
there's
they own.
there's a whole pile of them. I used to be married to a partner in a big New York law firm, Skadden Arps, and so I saw quite a lot. But one of the things that happens is the law firms are usually the conduit that hires the private investigator or security firms, or if there's certain kinds of surveillance and other tactics going on, special kind of research, certain kinds of pressure, it goes through the law firms behind attorney-client privilege.
Yes.
And so between the NDAs and all the secrecy, the law firms add another layer of secrecy to it. And because I will tell you, I just want to read you something from Gretchen Morganson and Joshua Rosner's book, They Are the Plunderers. She's describing one of the stinkiest deals yet, the executive life insurance deal with Apollo.
Yes.
And she describes how the pressure was brought to bear on the state, I guess it was the insurance commissioner, to do what turned out to be a horrible deal. And so well, let me just read it. Seconds after Marr hung up, another call came through. It was Hartigan, the Apollo lawyer. Angrily, he told Marr he'd heard Garamendi was choosing whoever and wanted confirmation. It was so obvious he had listened in on his short call. My phone had to be bugged. Okay. So, you know, my theory watching their performance year after year after year is this is a group of people who are teamed up with the intelligence agencies, whether it's private security firms or actually government intelligence agencies. They're using those tactics. So at Solari, when I litigated for 11 years, and I ended up doing a series on the Solari report called Deep State Tactics 101 that described every dirty trick and covert operation tactic that I dealt with for that 11 years, and my general counsel as well. And it's extensive. And if you look at what a private equity or LBO firm can do using those tactics, particularly surveillance, you know, if I'm competing and I'm an honest business and they have access to everybody's telephone, everybody's email, they have complete surveillance data, they're always going to outcompete me.
Well, you know, I'll give you an example from my court case. I could give you 20, but I'll just give you one. At the beginning of my case, I was not trying to leave. I was trying to stay with my group of franchisees that I represented as the union president. Okay. And they had a lawyer named Norman Leon, who was DLA Piper, also happens to be one of the senior lead counsels for the International Franchise Association and Fran Pack.
Wow.
They had him call up my lawyer and tell him, we want cooler heads to prevail. We don't want this to turn into an incident. I think we're going to just fix this. We'll fix this. So tell her to keep operating. We don't want the customers to know. We want to keep these customers happy. We want to be able to bring this back in. So just tell her to keep operating and we'll get through it. So I was told to put all of the trademarks back up on my walls, all of them. Okay. And this happened through communications, written and audio, between my lawyer and their lawyer and Fran Pack's lawyer, the IFA's lawyer. Right. And I did. I put them all back up on the wall because they told me to. And I kept operating. And during that time, they sent in private investigators to photograph them on my wall so that they could sue me for trademark infringement. And then when it came time for me to prove that, they hid behind privilege and lied to the judge in my courtroom.
Right.
And I actually had the proof. Fortunately, I had the proof that it had taken place. I had the proof of the reports. Norman Leon was sitting across from me and said I was a liar, and I went to pull it out and he wouldn't let me answer. And then they looked at the judge and said, she's not allowed to use rebuttal evidence, Your Honor. And said I wasn't allowed to show them.
Right.
And simultaneously, you know, the same court case where they got the arbitrator ordered me not to talk to my own lawyer the whole week. So I couldn't even help him, and I was the only litigant. And I had all the documents, and I couldn't even prep him every day. Like the tactics that they use are horrifying. They've sent felons with 88 felony convictions and 13 years hard time. They gave them my address, sent them to forge documents in my case. We proved it.
Right.
Right? They forged documents and sent them to every member of the union saying I was abusing children. They used it, right?
Right.
They've done horrifying things, terrorized everyone I know, all my employees. Like they can do it, and they do it every day.
But it's organized crime.
Yes,
It's not
it is.
business. It's organized crime. It's a shakedown. You're dealing with the Russian mafia.
And it's organized crime that hides behind the bar that no longer fulfills its ethical obligations to like holding attorneys to ethical standards.
Right.
You can't. The bar is sanctioning this violence.
One of my favorite, we had a judge who was the former CIA general counsel, and he, talk about dirty. It was unbelievable. But we had a Department of Justice attorney who'd come to HUD to be the general counsel of the IG, and she falsified evidence. And we caught her and were able to document it and turned it into the court. And she didn't realize we turned it into the court. And she writes a letter accusing us of obstruction of justice, which was the phony frame that we caught her. Anyway, one thing led to another, and we caught her in some other stuff. And she ultimately had to resign because the whole thing had failed. She had mud on her face. You know where she went to work? Arranged, I believe, by the general, the former CIA general counsel. She went to run the ethics committee at the DC Bar Association.
I'm gonna meet your bet, and I'm gonna raise you 2 chips because in our case, apparently this is a whole standard operating procedure. Because in our case, I happen to have been terrorized and forced, and I apologize if this triggers any of your viewers, but during my case, the opposing counsel wanted me produced faster for deposition despite me being on bed rest with a pregnancy. And they filed a motion to force me to schedule an abortion because they said I was going to need one anyway.
Right. I heard you made a video about this, and I heard it. And you know something? It's exactly the kind of things they do.
Well, so they did this, and they applied immense pressure, and then they threatened me with sanctions motions if I didn't comply and schedule an abortion I did not want. As a Catholic woman, I would not schedule. And when they did this, it was a crime because they did it in Arizona, where it's actually a crime to coerce an abortion. That is a crime. And I went to the State Bar Association and filed an ethics complaint against the 3 lawyers were like Madeline Cordray, Norman Leon, and Laura Six Killer. I filed this motion, and they took it very seriously. And after a couple months of me sending in all the evidence, sending in videotapes, all of the timed receipts, all the emails showing they filed these motions to force me to have an abortion in this secret courtroom, he said he was going to get this to a hearing, and he disappeared. I had to fly to Arizona to get somebody to respond to me after that, and we found out that at the same time, my arbitrator was made the chair of the Character and Fitness Committee for the state of Arizona Bar. I hate that we have such identical examples, but when I say this is crime, it's a death sentence. When they could target you and come after you forever, there's never a way out. This is absolutely endorsed by the bar that governs itself. We should have community oversight of bar associations.
So one of the things I will say is when, the only way you succeed in these situations is you have to just work it. Okay. And it's a lot of work, as you can tell. And when you work it, what happens is they have to buy everybody off. And so you end up blessing hundreds of people who all get promoted when they sell you down the river.
Yeah.
Right.
Oh, well, look at who survived in their corporate office, because almost nobody, but everybody that testified against me did.
Okay, so we've talked a little bit about fees, but let's talk about returns, because these deals are so loaded down with returns, and we have the secrecy and disclosure problems. And the reality is, they are not producing, there was a belief that they produced higher returns in the early years because it was sort of new and there was easy pluckings. Yeah. But if you look at the last decade, they haven't been able to produce the returns. And then coming into high interest rates with adjustable rate debt, you haven't been able to do IPOs. You haven't been able to create enough of a private sales market, and they are basically choking on their portfolios, and the returns aren't there. So I just want to show one live clip of, I don't normally show clips of Warren Buffett, but this one was priceless. I don't know if you've seen it.
I would not get excited about so-called alternative investments. There's supply-demand situation for buying businesses privately and leveraging them up has changed dramatically from what it was 10 or 20 years ago. But we have seen a number of proposals from private equity funds where the returns are really not calculated in a manner that, they're not calculated in a manner that I would regard as honest. And so it's not something. If I were running a pension fund, I would be very careful about what was being offered to me. It's not as good as it looks, and I really do think that when you have a group sitting as a state pension fund,
Warren, all they're doing is lying a little bit to make the money come in.
Yeah, that sums it up.
Like I said, you can keep that balance sheet looking pretty good for a decade until the cows come home, you know?
Right. So Munger couldn't stand it anymore, and he had to just jump in and basically call it what it was. But one of the papers I took a look at was one from Oxford University called "An Inconvenient Fact: Private Equity Returns in the Billionaire Factory," published it in 2020. Let me just read. Essentially, what he said is, you're not getting better returns; you're just paying bigger fees.
Yes.
Right. And so why should you do if you're not going to get outsized returns, there's no reason to go illiquid.
I mean, I agree with you, but there's a lot of reasons if you're trying to do things nefariously because there's no oversight. There's lots of reasons if you want to do things that you couldn't otherwise get away with in the public markets.
Right.
That is the impetus that I see, right? And the consolidation is also the impetus I see. I don't know if you're familiar with this statistic or not, but statistically over the last 4 years, private equity owned bankruptcies they've reached new records each year, 4 years in a row. But last year, private equity owned businesses were responsible for 67% of all large bankruptcies. This is bankruptcy for like $100 million. This year, we've reached a new record. It is now 71% of all large bankruptcies, right? And if you look at bankruptcies, even of small businesses, you're still at like 56%.
Right. But there's no, what I would say, and it's the nature of the extraction model, that's not a performance, that's a plan.
That's a plan. And it is executing. And unfortunately, that leaves all of the employees unpaid, all of the small business creditors unpaid. It leaves all of the landlords, the small landlords unpaid. But you know who's first in line? The private equity firm, and they're going to get paid
And
first.
you know who else it leaves them? It kills the tax base.
Yes, it does, because we have to bail all of that out.
And that's what's so strange about state pension funds financing this, because it's killing, they're funding the killing of their own tax base.
Yes. And it kills their own tax base in a multitude of ways.
Yeah.
I mean, a lot of people think that, oh, Joann's went away. Oh, shucks. No, Joann's went away. And as a result, 6,000 parking lots in the United States filled with small businesses lost their anchor store.
Right.
And those hundreds of thousands of small businesses now no longer have traffic coming to their parking lots. And they're going to start to close, which is why, for the first time in decades, we saw 150,000 small business jobs lost when historically they're the job creators in economic. Small business create jobs. And we're losing that now.
Right. And that's going to slaughter the tax base.
Yes, it is.
Now, they're going to blame it on AI, but it's not AI.
It's not AI. I promise.
It's not AI.
We don't really have AI right now. What we have is a really good excuse and a very, very expensive parrot that is very well trained to do a couple things that need constant human oversight. There is not an AI that has replaced a single job, but it's a great excuse.
Right. I totally agree. Okay. So we've mentioned concentration, but now let's look at some charts. So Dr. Mark Skidmore from Michigan State University is a wonderful economics professor at the university who I've had the privilege of working with on many different projects. But he is, we have a young builders course, and he's preparing a course for the young builders. And he made a series of charts to show concentration in different industries. And I said, Mark, you have to let me use those. So he said yes. And I want to show you a series of charts. The first one, consolidation and control, and it All of these charts start at 1970 except for the first one. So we've got 6 charts. The first one is 1990 to date, and then 1970 to date. And it's showing it in gasoline, in community banks. So gasoline 25% concentration, community banks 70% have been bought up, farms 30%, retailers 37%, convenience store 33%, manufacturers 30%. So we're watching massive consolidation across the board in all of these enterprises that used to be owned and operated by families. And it's extraordinary because that is the tax base.
I think the community banks scare me the most.
Yes.
I mean, all of it scares me. I'm anti-monopolist, and I believe that our FTC and our DOJ have woefully failed us, but Congress, in failing to update the antitrust laws, has failed us more. But the community banks scare me to death. I think we should have 10,000 different banks. I don't think we should have 9.
Richard Werner has done several studies for us or with us, one in Tennessee, one in Florida. And what he shows you is the more good community banks you have, the more growth you have without inflation. And when you shrink the community banks, you simply shrink the economy for no good reason other than to destroy independent income. You know, it would be only, and the reality is it's the independent income that's the basis of a democratic process or a healthy society. And without that, you have enormous central control. So let's look at the other one. And this gets even more frightening. One is independent physicians and independent dentists.
You know, I don't know if you know how much COVID had to do with a huge acceleration here, but in the state of Maryland, they made it illegal for regular pediatricians to offer any well child care during COVID. You could only go in for emergencies, and they lost 90% of their revenue. They couldn't
Oh
do
my God.
physicals. And so I say this with very personal experience. We had an amazing doctor named Dr. Beck. She'd been our kids' doctor since they were born. And during COVID, her practice, her small one person independent practice, went out of business because she lost 90% of her income due to state mandates. And she was forced to sell to another consolidator, just like all of the children's businesses were forced to consolidate because they were shut down for a year and a half. They were forced to sell to evil corporations like the one that owns the Little Gym now, the one I'm fighting, right? So
is it a good idea, do you think, to allow PBMs to buy up independent pharmacies? I mean, should PBMs be purchasing pharmacies and purchasing doctors' practices in some cases and purchasing hospitals or merging with hospitals? Is that kind of consolidation, vertical consolidation across the medical supply chain, is that a good thing for patients?
No, and we know this from various studies, including studies that we've conducted looking at patient outcomes. When that has occurred, outcomes on patients are worse. If outcomes for patients were actually better in terms of access, quality of care, and things like that, we would be having a different conversation. But instead, we're seeing the opposite. And in particular, it's because they're prioritizing kind of bottom lines. What can they do to be able to maximize profit instead of actually thinking about patient outcomes?
Let me read to you from a recent news article about private equity and their entry into the healthcare system. Here's a quote: "When private equity enters healthcare, closures are not side effects, they're the business model. Extracting value for investors comes at the cost of extracting access from patients."
COVID was an accelerator of this in ways people just don't discuss.
Right. Let's see the next chart. So I told you last night about the extent to which life expectancy in the U.S. diverged from the other 20 sort of high-income countries from the time, if you look at when the money started to go missing from the federal government and private equity started to grow, here's what we saw: life expectancy steadily diverge. And then, of course, in the pandemic, it falls off the cliff. And so if you look at the divergence of life expectancy in the United States from all the other high-income countries, it's extraordinary. It's absolutely
I
extraordinary.
worry it's going to get so much worse too with our younger generations and the younger millennials that have been living in a constant state of just chronic stress and lack of hope for the last 25 years with just huge hurdle after huge hurdle after huge hurdle. I worry this is going to get so much worse.
Right. But if you look, so let's turn to private equity in healthcare. Because I think if you look at how private equity is making money rolling up physicians, rolling up hospitals, being involved in pharmaceutical and insurance, as well as services for autistic kids, They are literally making money. So you just saw the numbers on life expectancy.
Yes.
The Swiss system, which is arguably one of the best healthcare systems in the world, costs $8,500 per person. Our system costs $13,500 per person.
Yeah.
And I think one of the reasons you see those numbers is the healthcare system is poisoning people, and then you make huge amounts of money telling people that the toxicity, the symptoms of toxicity are a disease.
Yes.
And then you make a fortune, and so it's a business model. And I remember when the COVID injections first came out, one of the business newsletters wrote and said investors are expecting to make a fortune on mRNA technology. First you have the COVID shot, but then they listed all these other vaccines that were going to come, and everyone they listed was for something that was going to be the adverse event that occurred from the first vaccine.
Yeah.
It was the perfect business model. So, and I don't think that's an accident. So let's talk about some of the healthcare. You've pointed out that in nursing homes and hospitals, the outcome for the patient is much worse if private equity is involved.
It's quantifiably worse to a degree I think would shock most people to hear it the first time. So they did a recent study, actually our government and a couple of research institutes did a study of Medicare patients having surgery in private equity owned surgical centers. And the chance of dying in the 30 days after that surgery, if the surgery took place in a private equity owned surgical center, was 42% higher. You were 42% more likely to die in the 30 days after that surgery due to complications and improper care than you were if you had surgery in a non-private equity owned surgical center. That is astronomical, right? And there have been multiple studies that have confirmed that you are between 10 and 13% more likely to die of whatever illness you're suffering from if you walk into a private equity owned emergency room because they don't have the staffing to properly diagnose and care. Right. So you have a 13% increased risk of dying of pneumonia walking into that facility. 40%, 42% technically higher increased risk of death after surgery in these surgical centers. But we're also seeing huge increases in the nursing homes and the recovery centers, the rehab centers that are private equity owned, which are far more staggering. And Carlisle, which is somebody we talked about at the beginning, was sort of the model creator of that method, right?
So they had a manor care deal that was particularly egregious.
$6.5 billion to buy up hundreds of nursing care and rehab care facilities that they stacked with billions of dollars of debt. And then during their not even lengthy ownership period, they dividended back. They sold all the land out from under them. They created large bills. They cut down all the staffing to a point where at one point, one RN would be responsible for 65 patients with no doctors on site.
Oh my God.
There are some really horrifying examples of what happened in those facilities. For example, one woman, she was having a problem. Her breathing apparatus had slipped and she was slowly suffocating. And she rang her bell thousands of times and finally was able to reach her purse and call 911. And she was code blue by the time 911 got to her room. She'd been ringing the bell for 2 days, begging someone to help her breathe. You are more likely to sit in your own feces or urine in those facilities. You're more likely to be dropped. They have far worse patient outcomes for bed sores because they are not properly cared for. These facilities are the outcomes are terrifying.
So I was just going to read you. So the National Bureau of Economic Research did a February 2021 study. Revealed during the 12-year sample period study, the Bureau believes private equity ownership of nursing homes cost 20,150 American lives.
Correct. Almost 22,000 of our grandparents, 22,000 of our veterans, huge numbers in veterans, right? 22,000 of our greatest generation. These are people that had families and loved ones that thought they were making good choices for them because all of the litigation about these facilities took place in arbitration. So no one knew that there were terrible things going on there, right?
Right.
And that means 22,000 senior citizens died up till 2021. This is what they found with just a small sample, including the Carlisle group, right?
Right.
But this is continuing to happen. It is not getting better. It is getting worse. The consolidation is increasing. Recently, we saw a group that came in and manipulated what was like an HOA fee, where a bunch of senior citizens had bought in for a lifetime lease in these senior communities where they would
That's
have
the problem. You lock in one condition and then private equity changes the deal and
Yes.
pulls the capital out, and you end up having paid for one thing and getting another.
Yeah, senior citizens they're buying in with $350,000, $400,000 to live there for the rest of their lives, right? And then private
Right.
equity comes in and buys it, and they'll add a new like HOA assessment. And I have seen examples of these companies coming in and adding $7,000 or $8,000 a month as a fee, so that these people they end up homeless. They're homeless and they've lost their life savings that they bought into a community they were supposed to live in for the rest of
Right.
their lives, and they're homeless. And then they extract all the money, and then the whole community ends up bankrupt, and then it rolls to the next guy in bankruptcy, and they start all over again. And it's wash, rinse, repeat. And it's always with our most vulnerable, always.
So, Grassley and Whitehouse, Senator Grassley and Senator Whitehouse just produced a study this year, Private Equity in Healthcare, shown to harm patients, degrade care, and drive hospital closures. I think that was the Stewart Hospital situation, but
Yeah.
big report from the Senate. So it's not that
Oh,
and
they
here's what's
know.
interesting. They know, and
They
they're
know.
still giving them the carried interest.
And they're still collecting all of those donations, bribes, whatever you want to call them.
Right.
They're cashing in big.
I'll call them bribes.
Yeah.
Okay, so one of my favorite authors, I don't know, and researchers is Toby Rogers. Are you familiar with Toby Rogers?
If they research private equity, I've probably read it, but I don't recognize the name. I'm sorry.
So Toby Rogers, he's an American. He did his PhD in Sydney because they have one of the best University of Sydney has one of the best political economy departments.
Okay.
And he ended up doing his thesis on the costs of autism. And he's been sounding the drum for years, trying to tell people this is going to bankrupt the country. This is going to bankrupt the country. This is going, and he's been very critical of Maha because he keeps saying, "Look, we didn't get you elected so that we could hear about Fruit Loops. We know what's causing autism. And it's really not. It's huge neurological damage coming off from pharmaceuticals. Anyway." Toby and I have done a couple of interviews and we've tried to integrate the model. And what he's realized is if you can't go to the third world and plunder the third world, the way you plunder the third world, the first world, is by making people, poisoning people, and then you get them on the allopathic medical model, and you start off with a $1 million home and $2 million in your brokerage account and $1 million of saving at the local bank. And by the time you're through going through the allopathic medical system, you're bankrupt, right?
Yeah. One of the things that people are talking about is this huge cash infusion that's going to come to millennials as the boomers retire, but that's not who's going to get that money. That money is going to these private equity owned pharmaceutical companies. It's going to go to these private equity owned nursing facilities. It's going to we are not a society. We have been conditioned as a society here in America to separate from our loved ones, that we're encouraged to cancel our parents or to cut contact. We don't live in an environment where we're all together anymore. We're not multi-generational. And as a result, all of our money is going to end up going back to the system, and it's never going to go to.
It's so frightening to see young people supporting policies that's going to be used to steal their family wealth and inheritance.
It really is.
So there's a study called Pocketing Money Meant for Kids, Private Equity and Autism Services. Have you seen that one?
I have seen that study, actually.
I wanted to show the chart. I think it's chart 3. I'm sorry, it's a graph, and it shows basically what you see is starting with a financial crisis. Almost all the deals on autism service centers are private equity.
Yes.
And here's what it says. The 12 private equity-owned ABA autism service chains examined in the study employ at least 30,000 people at 1,300 locations. That's extraordinary. Okay, look at this chart. Okay? What it shows you is they basically understand that a process is underway by the pharmaceutical companies to poison kids, causing neurological damage, and that's going to create a market of providing autism services because parents are going to be overwhelmed. And private equity is anticipating that and basically buying up the industry to provide those services.
I talk a lot about something that happened in 2014 and again in 2020, where there was a big meeting of private equity investors in Sun Valley, Idaho. The second one was, I don't know where the first one was. I've been spoken to about when it happened. But there was a big meeting where they were trying to decide what were the things they should invest in that they knew would be ironclad that would survive any recession indicator, economic downturn. And they had speakers there that talked about the importance of investing in things that we were emotionally in lock with. And so they wanted to acquire things we would find a way to pay for no matter the cost. If we didn't have the money, we'd borrow it. We wouldn't borrow it, we'd steal it. If we couldn't steal it, we would sell what we had to get it. These were nursing homes. These were autism facilities. These were veterinary clinics. These were funeral services.
Right. So we call this an inelastic demand.
Yeah.
They were looking for things that people of middle or modest income have an inelastic demand for. That's what they were looking for. So anyway, so let me keep going because one of the ones that frightens me the most is insurance.
Okay.
So we did a wonderful interview with Lucy Commissar, wrote a special report on private equity getting their claws into insurance. And it's pretty scary. I think she did 2 reports. And one of the problems is you can see when a private equity firm buys an insurance company, but a lot of times they won't buy the company. They'll make a deal to provide annuity or, handle their investments. So it's coming in the back door and you can't see it clearly from the disclosure. Now, here's the problem. Insurance is one of those industries where I buy an annuity or I buy a life insurance policy and I pay based on the credit. And then the private equity firm comes in and does a series of things to make money that dramatically reduce or destroy the credit. But I'm locked into my original price.
Yeah.
So, and if the state insurance commissioner is not stopping or watching this, there's nothing I can do. I'm just getting my savings stolen.
Yeah.
What really concerns me is that this is really going to change the nature of our economy and the nature of sort of wealth distribution in the United States, which is the nice thing about mom and pop shops is that mom and pop generally live in the community. And as these businesses get rolled up, it's not just that mom and pop are potentially going to be sidelined economically. It's that the income from these businesses is going to be funneled to, sort of larger and larger corporations that may or may not be based in the community. And I think that that is going to have a really profound effect on our economy in a way that I think regulators and observers are just starting to grapple with.
Yeah, and our culture too.
Yeah. Yeah.
I mean, I live in small town America, right? The local hardware store, the one that's left, sponsors the local basketball team or the little league team.
It does concern me because my girlfriend is a veterinarian. I doubt that there's going to be mom and pop veterinary clinics in a decade if the current trend continues. The same with hardware, the same with OBGYNs, the same with plumbers and a whole bunch of different industries, unless we decide we want to go a different path economically.
I feel like there has to come a moment where we're going to, I believe we should have hit enough is enough so long ago. I want so badly for people to start screaming and marching, but I think they keep us so overtired, so overextended, so underfunded, so exasperated, so unable to provide for our children that we're just everybody's too tired to fight.
So we're going to talk about what we can do, because I think there's a lot of things we can do. Okay, let's keep rolling. Sports, they're now in college sports.
Yeah, but they're also in youth sports. They've acquired almost the entire youth sports industry. There's almost nothing left.
Youth sports used to be a great equalizer, where children from all backgrounds could learn teamwork and grit and build community bonds. Today, it has become the next victim of a financialized economy. Private equity is stealthily capturing youth sports, using the same playbook it has deployed in veterinary clinics, nursing homes, fire truck manufacturing, and countless other industries. Kids are burning out because of specialization, and injuries are on the rise. Families are going into debt, and it's based on a lie. 49% of parents believe their children will earn an athletic scholarship. In fact, only 2% of college applicants actually do. So what does youth sports look like today? Take 3Step. It claims to be one of the largest youth sport event organizers in the country, It operates over 5,000 clubs across 7 sports and promises families, quote, immediate national brand recognition within the college recruiting landscape. Black Bear Sports Group operates over 40 hockey rinks across the Midwest and East Coast. A recent report by The Lever revealed that Black Bear is often the only game in town for hockey leagues and tournaments and forces parents into its streaming service to record games. Varsity Brands monopolized competitive cheerleading, as insiders put it, from bow to toe. So how did this happen? First, a private equity firm acquires competitors through hundreds of small acquisitions. Next, it eliminates competition through vertical integration so it controls the whole ecosystem. Finally, it extracts maximum profits from captive customers. In this case, parents who have to pay thousands of dollars for their kids to play sports. In short, private equity is turning what was once an affordable public good into a profit extraction machine. The numbers tell the story. Youth sports has grown into a $40 billion industry, roughly equal to the annual revenue of the NFL and all of college athletics combined. How did we get here? The 2008 financial crisis, slashed parks and recreation budgets, the COVID-19 pandemic delivering another crushing blow. Community programs have disappeared, and private equity is ready and eager and has filled the void. These firms control leagues, tournaments, venues, uniforms, tech platforms, and even governing bodies. They create a flywheel that extracts more and more revenue for wealthy investors, and trapped families have no choice but to pay.
There's not a single rec league in many communities, and they've made it a $40 billion industry, but it wasn't a $40 billion industry. It was an $8 billion.
And they've shut a lot of families out of sports because the kids can't afford it.
So there was a senator that was at his son's hockey game just a couple weeks ago. And it was at a Black Bear Sports owned facility, Black Bear Private Equity. Okay. It was a hockey center. They bought all the centers in the area and got a monopoly, which is, I talked to you about regional monopolies a lot yesterday, but they were at a hockey facility and he was taking a picture of his son and he was approached and they said, "I'm sorry, sir, what are you doing?" And he said, "I'm taking a picture of my son." "Why?" And they said, "You don't have the package that allows you to film your own child, sir." And he said, "Excuse me?" And they said, "You have to pay for a membership to film your child. And if you don't, then we're going to have to take action." He said, "What kind of action could you take?" And he said, "Oh, it was built into your contract that if you get caught photographing your son, they lose playoff contention or they get demerits against their playoff contention calculation and they get removed from the playoffs. So you will not film your son."
Oh my God. Do you remember the senator's name?
It was Connecticut. It was Murphy, I think, Chris Murphy.
Okay. Wow.
And it went very viral. I was actually on InfoWars the night it happened, and we talked about it ad nauseum. And it went so viral that Black Bear Sports has come out and they have clarified their position. And they are no longer saying you can't photograph your children, but you absolutely could not like call your husband on FaceTime and let him watch because you cannot broadcast your children because they sell a broadcast package now. You also can't like do a photograph next to the sidelines. They've come out and made a bunch of statements because it was such a huge backlash that private equity is not used to. But this is not a one-off problem. This is happening in every part of sports. It's happening in lacrosse. It's happening in travel ball. Somebody sent me a message yesterday that said his daughter wanted to do travel volleyball. $10,000 for a 3-month season for the travel. $10,000 for 3 months. Now, another woman came and talked to me about how her daughter got a grant from the state of Maryland to do gymnastics. She got a grant because the private equity firms had bought up all the gymnastics facilities, including the one that I used to run here in Maryland, right? And she got a grant to put her child in gymnastics, and she's actually very, very, very good. But because the grant only includes local stuff, her daughter is not allowed to travel for any of the competitions, and she got given a price, and it was $17,000 for 4 months. $17,000 for 4 months. Travel baseball, I've seen $8,000 figures.
So I'll tell you very interesting things. The New York Times, one of the great political successes in America has been homeschoolers. You know, if there's anything Mr. Global is afraid of, it's moms.
Yes.
Because the moms keep whooping their butt, and they whoop their butt on homeschooling. The New York Times just came out with a huge attack on homeschoolers. And I bet it's because the private equity firms don't want leakage out of their different, they intend to make a fortune in education.
Yeah. I used to think that school choice and funneling the money to people was this really great idea until I realized private equity had bought up all the private schools.
Right.
One of my favorite things to talk about is a company called Spring Capital, which is owned by Primavera Capital. And Spring Capital owns the largest elite private school institutions in the world, including a whole bunch in Bethesda where the politicians' kids go. And while they're busy trying to cancel TikTok for being affiliated with the Chinese Communist Party, they don't recognize Primavera Capital is a Chinese Communist Party managed private equity firm that owns all of the private schools in America and is writing their curriculum.
Oh, Jesus.
What could go wrong?
So I don't know if you know this because I followed TikTok a fair amount. TikTok, before the brouhaha started, was majority owned by U.S. private equity firms. KKR had a position in
Yeah.
TikTok.
KKR still
The
has a
problem-
position. They haven't been bought out
Right.
yet, but they're getting close.
Right. The problem was you had the Chinese founders who had 20% and they had operational control. Right. That was the problem. So and they kept saying it was Chinese owned, but in fact the majority of the equity was American buyout firms.
They also had 7,000 American employees that each had equity.
Right. There you go.
Huge equity here in America for TikTok. That's not
Right.
why TikTok was canceled. TikTok was
No, it was canceled because Larry Ellison wanted control and his
correct.
pals.
It was all for propaganda, and there was an immense amount of money spent by Meta to get rid of their competition as well, almost $60 million.
Right. Right. Very, very stinky. Okay, let's turn to retail because retail, we've seen Red Lobster, Joanna's, we talked about Hooters, all these companies stripped, but we've also seen companies that have invested hugely. It's not just private equity, but private equity is in the lead on what I'll call dynamic pricing. Okay. And there are thousands of schemes in dynamic pricing, but one is you rent a car online and the next thing you know, they add this and that and this and that and that, and the price doubles and and they don't have the car and you can't get anybody to talk to you unless you call the 800 number, and good luck with getting a human being on the 800 number, right?
Without a fee.
Right. And it's all orchestrated by algorithms to figure out how much you're willing to pay to just give up and go away. It's an extraction model, and it's basically, it should be illegal, but we've seen an enormous deterioration or bankruptcy of all sorts of retail stores. Any thoughts on what private equity is doing in retail?
Private equity in retail has been consolidating and limiting any type of differentiators in the market. I like to say that millennial grage is absolutely an outcome of private equity consolidation. They want to produce as few options as possible, take away our individuality, which I think is really important to them, is limiting individuality so that we're marching in lockstep as good little workers, right? As they strip mine everything that we care about, everything we build, all of our excellence and all of our ingenuity.
Do they just want us buying everything online?
You wouldn't think so, given that they have some like real estate investments and commercial real estate investments. You wouldn't think that. However, if you want to control the way that pricing happens, buying online is certainly more effective, although they're getting better at doing it in person. And I'm going to give you a non-private equity. Well, there's a lot of private equity invested in their institutional investors, but Walmart. Last week I went to Walmart. I left my phone in the car. I left my daughter in the car. She's old enough, don't worry. And I had to run in to buy one single thing. I did not put in my phone number. I went in there and I paid cash. And when I went to finish paying cash into my self-checkout, it asked me if I would like the receipt sent to my phone, Mrs. Cianci.
Wow.
I didn't bring
Biometrics,
my
they've
phone
got
in.
your
I didn't use anything that would allow
No,
them
but
to do it.
they recognize your face.
And they followed me through that store. They knew what I had bought. There is nowhere we are not being tracked for our purchases at this
Right.
point,
Right.
except in small mom and pop stores all across your community. And that is
Right.
why I'm going to continue to say that the safest path we have forward is to just force away from it.
Here's what I will say. We're not going to talk about food, but I will tell you that the deterioration in the food system and the corporate food system is such, if you don't have a farmer and rancher that you can trust that you can buy food from, it's not safe. It's
I agree
just,
with you.
it's not safe. One thing I do want to say on media, we talked about TikTok, but we have a lot of material on Solari Report about what I call neuro warfare. And I think one of the key tactics that they are using is they are using neuro warfare on the phones, on the digital TVs, on everything else. So, when I was on Wall Street, I heard two billionaire types in 1984 talking about entrainment technology that was going to be rolled out on TV and subliminal programming, and it scared me to death. And that was it for me in TVs. But I think they've rolled that stuff out, and I think it's very much in the mix. And
I've been wondering about lighting because I recently watched a video study of children in a classroom, and there was some children that were clearly demonstrating under these like pulsing LED lights, propensity for like hyperactive conduct, which first of all, kids need to be outside playing. They don't need to be in a classroom 8 hours a day,
right,
right? They need play.
right.
And I have a small business that creates play-based learning. That's very, very important. We need to bring it back. But then they moved this child and the other kids that were struggling with those same issues to a classroom that had incandescent light, and it almost stopped. They filmed them for weeks in each environment, and it almost stopped. And so now I've started to wonder about the lighting.
There's also, I don't know if you've ever seen this, Jeffrey Smith had it on his website. It was a short video about a school, I think it was Happy Valley, Wisconsin,
Mhm.
where the kids had, there was a lot of behavioral problems. There was a lot of bad behavior, a lot of low grades. They stopped buying the corporate food and they bought all local fresh food. All the behavioral problems went away. The grades skyrocketed. Total change.
I'm glad you brought that up because one of the things that's been really horrifying to watch in the current administration, it's been really hard for me to watch, is that they went in saying they were going to engage in MAHA. And as you know, I've been on Robert F. Kennedy Jr. show. I've spent a lot of time in the MAHA environment, talking largely about private equity in healthcare. But one of the things that's happened is that while they put Robert F. Kennedy Jr. in HHS to make everybody happy, what they did was they put a bunch of lobbyists from the industrial farming community and the agrochemical companies in charge of the FDA and the USDA and the EPA. All right. So they put all
Really?
these lobbyists in charge over there. And one of the first things that happened was the USDA canceled all of the new programs that had just started in the 3 years prior that were connecting regional farmers to school cafeterias.
Oh, God, you're kidding.
They canceled all of that funding. And then they said, don't worry, we'll have some MAHA initiatives coming soon. But they terminated all of the programs that were connecting regional farmers that were already about to lose everything because we're putting all the soybean sales to China over to Argentina, and we're bailing out Argentina, and American farmers are losing everything.
It was at USDA?
It was USDA.
I gotta find
So we have
this.
the EPA approving new forever chemical pesticides and trying to get immunity for everybody for glyphosate so that they can keep poisoning everyone. And over at the USDA, we've eliminated all regenerative farming. We've eliminated all of the programs that connected regional and local farmers to the school lunchrooms that would have given kids that otherwise do not get access to organic or healthy food, access to immediate out of the ground healthy food. We've gotten rid of all of that. And now, don't worry, Lee Zeldin says now we're going to roll out a MAHA agenda because we've already destroyed all of the building blocks that were in place.
No,
it's horrifying.
One of the good things about Kennedy going to Washington, going through the confirmation process, I've never seen more overwhelming proof for the fact that the poisoning of America is intentional. It is intentional. It is a policy. It is a plan, and they are stuck on it. Okay, so let's turn to. I want to talk about Harvard and Yale. I've covered Harvard a lot because Harvard is an investment syndicate. It's not a university.
It's more like a big hedge fund.
It's right. It's Harvard Corporation is the governing entity, and the endowment is a piece of it. And essentially, the endowment has the benefit of tax exemption. And if they roll off 4% a year to the university, that's cheaper than paying taxes. And then they basically create a network that feeds the investment syndicate. It's very powerful. I mean, it's a very successful business model. Anyway, so I ran into a lot of dirty shenanigans in the housing market with their real estate investment crew. And because of that, I dug in and looked at Harvard. And in 2017, they announced they were going to fire a lot of their in-house management staff at the endowment and outsource tremendous amounts. And they were going to stop providing as much disclosure on the endowment. And I said, uh-oh, they're going to do plunder, and they want to team up with the private firms and keep everything secret, and they're going to make lots and lots of money.
Yeah.
But in fact, that's not what happened. They did dramatically. Yale was the leader of private equity in the endowments, but
Yeah.
Harvard came in as well. They did take up the private equity portfolio to what I would consider very dangerous levels. You need an institution like that needs liquidity. But they didn't make a lot of money because we've seen the whole industry stall on
Yeah.
higher interest rates and what's going on in the economy. And then Harvard runs into a big fight with the Trump administration, needs liquidity, goes out to the bond market, can't get it, and then announces they're going to sell a big portion. I mean,
Yeah,
billions.
between Harvard and Yale, it was almost $10 billion worth.
Right. Now, there's a saying in the markets, he who panics first panics best. And it looks to me like Yale and Harvard are panicking first. They're they're marking their portfolio down, and they're getting it out and getting the liquidity they need, because it's a different environment. And I'm shocked, because if I thought anybody could make money playing the plunder game, it would be Harvard, but apparently they got their heads handed to them.
Harvard and Yale both took a real hit here. David Swenson at Yale pioneered the private equity investment for endowment method. He was there from 1985 to 2021, I think. And he
Right.
pioneered the private equity investment strategy. But when you look at what really happened towards the end when they started panic selling, they were getting fewer than 6% returns, and they were paying 2 and 20% on the gains. And they were getting
Right.
nothing out of it. And you just mentioned that, he who panics first, and that they're discounting and selling. They're trying to sell everything on the secondaries market, and a lot of it is stuck. They can't get rid of it. And so what's happening is right now, just at Yale, I think it's Harvard, is $1.54 billion a year in management fees for the assets they can't sell.
Jesus.
1.54 billion, and I think you're at 1.23 billion at Yale. They're paying $1+ billion a year in fees because they can't close the funds and they can't get liquidity. So now they have to keep paying those fees to the private equity firms in perpetuity, whether they can sell them or not, through their 2 and 20 model. And so it's just giving them increasingly diminishing returns because they can't get anything out. And the interest rates are making the secondary markets incredibly skittish. They can't borrow.
I expect all the business schools to do case studies on this exact situation. Okay? Because it's another argument for liquidity.
Yeah.
Now, if you read the private equity literature, they're all now focused on creating secondary markets, including using asset tokens to create secondary markets. And the question is, why do we need you to charge enormous fees to take something private and then create, sort of, I don't know, high friction liquidity with the secondary market in the private market and with asset tokenizations? Why not just use liquid markets? What do we need you for?
You just gave us the $11 trillion question of assets under management, right? Because the reality is
Right.
that 2 and 20 model is paying them 2 and 20 on $11 trillion in assets under management. And it only took a few well-placed people that were positioned to make a lot of money convincing everyone else to do it. Right. And so what we have right now is we have it being perpetuated by these markets that we're not even like inviting people to the table anymore. Right. What they're doing is they're having, OpenAI is still private right now, right?
Right.
They just had a pre-sale that was invitation only, where people got to come in and they got to buy super shares before their IPO. And a whole bunch of very wealthy people came and gave them a bunch of liquidity to get super shares in advance of the IPO. So they have private share grabs right now, but we're seeing that all across private equity.
So I used to see wealthy clients I had would get approached and say, look, trust us, on the exit, you're going to get such and such a profit, and just come in, and, it's sort of rigged profits for the insiders.
But the secondaries market, and to be clear, the general partners that give the most money up front are always first in line in the liquidation. So they're going to get made whole. But all of the pensions that bought in and all of the 401k systems that now will buy in, those guys are not going to get made whole.
Right.
And we're seeing, as we saw with the Oregon School pension, as we are seeing from Harvard and Yale in real time right now, we've seen with CalPERS, we've seen with the Michigan state pensions, it's not working anymore. And the reason is because if these companies were actually worth what they claim they are worth, they would be able to sell them and close their funds. They need the secondaries market, which for anyone watching at home that doesn't know what a secondaries market is, that is a market where other private equity firms that also have stuff that is stuck buy from each other to keep the scheme going.
Right.
And so you have to create a fake valuation.
You have a company worth $1 million, but it's supposed to be worth 10 million, and I have a company worth $1 million and it's supposed to be worth 10 million. So I buy yours for 10 million and you buy mine for 10 million, and there we go.
And we kick that can 10 more years down the road, baby. And it will come home. These chickens will come home to roost at some point, right? But that hot potato keeps moving. And the secondaries market, even the Financial Times describes it as a pyramid scheme.
Yep. Yep. Yeah. When the Financial Times is I don't know, I'm not used to the Financial Times stepping up for what's right, but things have gotten so egregious that they've been doing more and more in that.
Yeah.
Okay, so let's turn to the Trump administration. So step one is the Trump administration refused to close the carried interest, which if you look at what was going on in the tax issues and how private equity has really been very negative for America, that's not what you do. You don't make America great again by giving benefit to the mafia who's destroying your neighborhoods, right?
No, you make billionaires great again, and that's it.
Right, exactly.
Nobody else.
Exactly. Okay. But the other thing is now we have an executive order for 401ks, and this is frightening.
The Trump administration has been very friendly to private equity, refusing to close a tax loophole that largely benefits private equity fund managers. And just recently, considering an executive order to allow 401ks to invest in private equity.
So explain the executive order for alternative investments.
So first of all, I fought so hard to stop this. We generated with my audience more than 200,000 tweets to Trump begging him not to do this. About 9 years ago, a bunch of private equity firms sent through a lobbying group to DC to start advocating for allowing diversified asset acquisitions in 401ks, pensions, and other retirement mechanisms.
And we're talking about 12 trillion. Is it 12 or 14 trillion in 401ks?
We're talking about 12 trillion in 401ks. $12 trillion. Okay. Now you compare that with $11 trillion in supposed assets under management with private equity, but it's illiquid, right? And 401ks have money, they have liquidity. And so what you have is 9 years of campaigning to try to get this access. And they were ahead of the curve. They knew they were going to need it someday, but no president would do it. No president would do it because it's insane. Because the 2 and 20 model says that if you, as an investor, aren't investing at least $10 million, you're going to lose money no matter how well it performs. You cannot make more than you could in the stock market. You are going to lose money just.
So I do want to stop you, because if you look at how 401ks are invested now, there's a huge amount of money going into the management companies that are trading publicly, because all those 401ks are in index funds.
Yeah.
And through the index funds, they're funding the people who are doing this.
Yes, that's true.
Right.
But if you look at the fee calculation between the two, if I invested $100,000 either in the index funds or private equity, my fees, if I saw a 150% return, we're going to go shoot for the moon here. We got 150% return on 10 years. Okay. And my 100,000 turned into 250,000. My fees to get that money out are going to be $6,700 total.
Right.
That's what I paid for my 150, $6,700. In private equity, I'm going to pay $60,000.
Right.
$60,000.
Right.
Okay. That's an astronomical sum, And so when you look at like the reason it makes no sense for 401ks, nobody's investing 10 million with a fund if you're in a 401k and that's your retirement plan. But these had all tried and everybody said no. It wasn't until they got together with crypto.
Right.
That was the game changer, because crypto also wanted access to 401ks and people wanted access to crypto in their 401ks. So crypto went to Washington, which is one of the most powerful lobbies there right now. Okay.
Right.
And crypto was almost across the finish line, but they'd run out of money to spend. Okay. And they had the crypto caucus, and they have now they've got crypto week like every quarter in DC. They're having all these crypto events, right? They had a crypto ball for the inauguration this year. But at the end of it, private equity came in and they said, hey, we'll back the rest of this spend to get this across if we can work together. And it's like a match made in hell.
Right.
And Trump signed the executive order against all advice. And now private equity, which has $3.9 trillion in unmovable assets right now that cannot sell in the secondaries market, has gained access.
Now, here's the thing. Standing between your 401k and their ability to stuff is a whole bunch of administrators.
Yes.
And they're going to have to work that system. There's a lot of friction in that system, and they're going to have to work that system.
Yeah.
And so it's going to take time, and that gives you time to either exit or make sure you're working back. Because the first thing I would do if I had a 401k is I would call up and I say, you better make sure that none of this gets stuffed into my, and whatever my options are, they are private equity free.
100%. And that is something that every American can do. Not all of them have the savvy to do it. Not all of them have the time, the energy. Not everybody knows that they have to, but that is one of the small things we can do to protect ourselves from what is the very steady strip mining of American excellence, ingenuity, and wealth in America.
Okay, so let me bring up a wild card.
Yeah.
Because there is a wild card that I predict will impact private equity. Private equity has been talking. So this year we passed the Genius Act, which was a regulatory framework for stable coins. And I believe they're going to use stable coins. Well, they've reserved the right. They've refused to outlaw CBDCs, so they could still use CBDCs. But they want to use stable coins like a privately controlled CBDC, same thing. So that's another problem that we're going to have to face, because the same guys that did private equity now want to do programmable money, and that's worse. But private equity has been talking about, so we have a new bill coming. The Clarity Act was passed in the House. There's a response in the Senate, and they're trying to work it out. When that bill passes, you're going to have a regulatory framework for all crypto, including asset tokenization. And private equity has been talking about using asset tokenization to create a secondary market, which, as far as I'm concerned, is ridiculous. Why pay all those fees to get to a less liquid market than the one liquid market you've already got? But put that aside for a second. Coinbase just announced that they are going to start in early 2026 perpetual 24/7 trading of stocks everywhere in the world.
Next up, we're launching equity perpetuals, so you can get 24/7 access to trade equities capital efficiently from anywhere. So let's take a look at this too. I'm back in the trade tab where there's a whole section for perpetuals. I can now see contracts for single stocks and indices. And early next year, these contracts will be available to traders on both our simple and advanced trading platform outside the US, enabling trading with up to 20 times leverage. Traders across the world will be able to react instantly to earnings, macro events, and weekend news with one of the most efficient trading instruments created in crypto, now coming to the largest asset class in the world.
And they say they're going to offer 20 times leverage.
The girl who grew up in Vegas.
Right. The US stock market is 70 trillion. The global stock market is 140 trillion. You allow, because right now it's very high friction. If I want to trade a market on the Swiss exchange, I have to go to a huge amount of work to open an account in Switzerland, huge paperwork, huge trouble, and then high fees to buy the stocks on the Swiss exchange. If I can go to Coinbase and simply buy a token which represents a stock on the Swiss stock exchange, there's no friction, there's no regulation. If I can leverage it with margin up to times 20, you can imagine the games that could go on. But here's the problem. If you're the private guys, the liquid markets are about to get a lot more trading happy.
They're going to get crowded.
Right.
They're going to get crowded.
How are they going to compete against that?
They already can't compete against that.
So you've got so say globally you've got $10 trillion in private equity, but the 140 trillion gorilla just got a lot more accessible and a lot more interesting and a lot more potentially bubbled, right? So the relationship between liquid and private is going to get very interesting here, Tiffany. I don't pretend to know what will happen.
I'm wondering if Coinbase is trying to get ahead of the AI bubble burst too with this, to prepare to bounce on it.
Yeah, could be.
They're going to have a mess.
The other thing I should have mentioned, because of the dreadful I think the impact of private equity on children has been absolutely dreadful. And uh, I think the thing that's going to get more dreadful is OpenAI just announced that they're going into porn in a big way. And that's
I
because they
love
can't
how I
make
just want to
money.
like just take a minute. You have to take a minute for the we're gonna cure cancer to we're gonna make unlimited kiddie porn like egomaniacal transition for Sam Altman there, everybody. We're gonna cure cancer last year. This year, we're gonna make porn. And it makes perfect sense. The single most profitable per employee company in the world is OnlyFans. They literally make like $30 billion per employee.
Right, but porn is the world's finest neurowarfare delivery mechanism.
Absolutely. And they're not going to stop with adults.
Right. It's great for brainwashing people, and it's great for addiction creation.
It's also going to make it impossible to actually find where the real porn and the real trafficking is happening because the market will be flooded with it.
Right. Right. So, I don't know, sometimes my father was a doctor, and he used to say, sometimes you just have to let the infection rise to the surface. So maybe it's got to get worse before it gets better. Okay, so now we're going to talk about the important part, and that is how to protect ourselves. So I had a wonderful colleague who's had a relative, young man, working for a company, and he kept identifying ways of improving the company's products, improving their profitability, and he'd bring it forward, and it would be rejected. And he was totally baffled. Why does the company not care about growing stronger and making more money? So I told the colleague, find out if they're owned by private equity. And sure enough, it was owned by private equity. And they were looking to get their money out fast and run, right? And
ingenuity is time consuming and resource consuming.
Right. And so what he discovered was he wasn't part of a business. He was part of a trade.
Yeah.
It was a transaction. And so, I think the first thing you have to do is you have to know who you're doing business with. You have to know who owns a company. So I think it was you who said, or no, maybe it was Gretchen Morgensen had a great interview where she said, if you go to a doctor and it turns out they've been rolled up by a private equity, you need to find another doctor.
I've said it. She's probably said it too. We both say that a lot.
What can regular people do? What can we do, on a day-to-day basis to push back against this?
Well, first things first, private equity is coming for the little guy's money now. Okay. Traditionally, they've been where pensions invest, where endowments invest, big institutions. But that pool is not getting larger fast enough for them, and they want additional fees and additional, enrichment. And so they're going to go after the little guy now. They're going to go after people like you. So if you get pitched on a private equity deal that just sounds great, just say no, okay? Because you're really going to be perpetuating this unsustainable business model. Second thing is, until we have more transparency about who owns what and whether my supermarket is owned by private equity or and whether my dermatologist is, until that happens, if it does, you've got to ask the question, especially of your doctors. Go to your dermatologist. Are you owned by private equity? Because if you are, I think I might take my business elsewhere because studies have shown that, increased costs, biopsies go missing, important health issues occur.
Look, the lack of transparency is appalling, but we don't have to tolerate the lack of transparency. Do you understand? We have mechanisms. So transparency is one very, very important facet of a multifaceted problem we need to address. But transparency, there are ways around it. It's just time consuming. I'll tell you right now, I have my secret weapon is that whenever private equity is acquiring something, they're also acquiring their intellectual property. And they never, ever hide that in the shell corporations quite as well. So if your local doctor has a sign on the door or a name that they've registered for a trademark in, you can go to the publicly available USPTO test system and see who owns that trademark, and it will have transferred to the private equity firm. They can hide it on the website. They can hide it everywhere else. You can't hide the intellectual property that is publicly available.
Wow.
So that's my favorite place to do research.
So one of my concerns is if my doctor has my private records and data, and he's bought by a private equity firm, they get that data.
You sure do.
Right.
They sure do. And the next time you log in to get your files, they're going to have you remind your terms and conditions will have been completely updated, and you won't even know you signed the rights away to somebody. You won't
Right.
even know it. You know, Blackstone, I think, owns Ancestry.com now, and they also own, they're selling all the 23andMe DNA right now in the bankruptcy to a bunch of private equity firms and pharma companies.
Oh my God.
All of the 23andMe database that is now bankrupt is being sold to the highest bidder. And there was a big hearing about it, and Josh Hawley really went to the mat on this issue, and it didn't matter. They were like, well, we have to sell it. We've got to make those creditors whole. He didn't say the institutional investors were the creditors they were making whole, right?
So that means be very careful who you give your data to. And
It's
don't sign.
it's
Do
becoming
not
where you
sign.
can't give it to anyone. It really
Right.
is. And I'm a big believer that right now transparency is definitely the path, but there are other paths we can take too. And I think the best path for all of them is through the referendum states. That's what I believe.
Yeah. So explain how a referendum. So there's several things you can do at the state level. One of them is a referendum. So describe what a referendum in a state that can do a referendum is.
So there are 19 states that have some form of referendum capability in the United States. Some of them are constitution amendments only, and some are regular bills. That what a referendum state like Nevada or Arizona affords you is it means that you as a regular citizen can write a law. And you can go out and collect, say, 10,000 signatures backing that law. And it goes immediately past the legislature and to the ballot. And in those circumstances, if you can get those signatures, you can get that law to the ballot. Trust and believe the private equity firms will come and campaign against you.
Right.
But I've got to say, it's not working like it used to, right? It's just not. And so we have the ability to start passing laws for transparency. We have the ability to pass laws to make arbitrators comply with the law. We have the ability to pass laws in our states that ban private equity from practicing healthcare. We have the ability in 19 states in the United States to pass laws to restrict the kinds of money that can own kinds of specific businesses.
So here's the thing. A state has the power to pull the license to operate in a state.
Yes.
So
Yes, they do.
that is an enormous power. And part of the problem is before it can pull your license, it has to go through its contracting budget and make sure it's fired you from the contracting budget. So no, because if you're purchasing and doing business with these guys, you can't just pull their license. So a state can move them out of their financial statements, and a state can literally pull their license to operate. And I'm one of those people who believe if people have a death penalty, corporations, if they have right of personhood, should have a death penalty.
I talk about this so often. There was actually one of the people who ran as an independent for president last cycle was Randall Terry. He said corporations and private equity firms don't have a soul to damn or an ass to kick, and we need to start holding them accountable like they do. And we just saw this with Boeing. Boeing was found guilty of felonies for lying to the government and allowing 300 souls to die on their planes by hiding that there was a defect. They were found
Right.
guilty of felonies, and no one went to jail. They got some small fine that became a cost of doing business, and 356 families went to arbitration.
Wow.
That's what happens over and over and over again, as long as we have allowed, and we continue to allow, our justice system and our legislative system to be bastardized in favor of these corporations. We already know that the legislators are bought and paid for. We know that. But we still have tools and weapons in our arsenal. We have to start using them.
So I think one of the most powerful political tactics that's ever occurred is boycotting and shunning. So my attitude is if you're interviewing for a job, you find out if they're owned by private equity, and if they are, walk away.
Yeah.
If you don't, for products and services, you don't do business with institutions that are owned by private equity unless you've seriously researched and due diligence and make sure that they are okay.
We're watching this happen in real time right now with the company I'm fighting. They bought up in COVID tons of children's businesses that only serve kids and only exploit the profitability of moms that are trying to take care of their kids. So they acquired adventure parks called Urban Air. They acquired the Little Gym, which was the brand that I owned, Snapology, XP League, Class 101. They said they were going to have control of mom's pocketbook from cradle to college. That's what they promised. And they were going to build a big umbrella that controlled and built data models based on parents and what they were willing to spend on their children. And what happened was they started cutting corners to get more money. And I ended up getting sent some documents that showed they were cutting corners in these urban air adventure parks. And in these adventure parks, they were cutting harness checkers on zip lines that were 35 feet up in the air over concrete floors and metal fences. And the safety team had told them, don't do that. And in the documents I had, it suggested that they were overridden, and the CEO's team at least advocated for it to happen. And just a couple weeks later, children started falling off these zip lines 30 feet to concrete floors, breaking every bone in their body, rupturing organs, permanent brain damage, blindness, scalping, quadriplegia, paraplegia. Well, all of them got forced into secret arbitrations. No one knew. No one knew until I got sent those documents. And their cuts have continued. They started advocating for hiring 14-year-olds to run these parks with attractions where children could die, people could die. Recently, a woman was strangled, and then in Georgia, a 6-year-old was strangled on these rides, right? It just kept happening. Well, this past weekend, a beautiful 6-year-old little girl named Emma died in one of their parks. These private equity-owned urban air adventure parks, little gyms, Snapologies, right? When you pair private equity with our senior citizens, when you pair them with healthcare, when you pair them with our pets, when you pair them with the lives of our children, it doesn't mix. And people started calling boycott online.
We didn't talk about the rolling up of the veterinarians, but that's very significant. We've talked about that on the Solari report. And that's one place where when you go to a vet, you need to make sure it's not owned by private equity.
Yes. Very important. They've gotten almost 76% has been rolled up at this point in major areas.
Right.
That's a terrifying number. And they're price fixing. They're price fixing in every industry they get to, whether it's serving your kids or your grandparents or your pets. They're price fixing and they're creating regional monopolies. This is something else. The referendum law, we can write new antitrust regulations to stop. We can stop this, but it takes effort.
Can a state write regional antitrust laws and enforce them?
It's never been tried, but I think we could. Yes.
I think we could
Antitrust
too.
laws are the only laws in the United States that have a civil and criminal penalty or a civil and criminal prosecution method, and that are allowed to be prosecuted by regular citizens. They are the only laws where you don't have to wait for a prosecutor because you've been harmed as a citizen if antitrust or anti-competitive conduct is being executed. The problem is it's so expensive that we would have to all work together to make it happen. But with new laws, we could make it more affordable. We could make them pay the bill. We could literally say, and when we bring it, they have to pay the bill if we meet this benchmark. That is something we could write in from day one.
That's true. That's true. Now, one thing we can do is we can stop our pension funds and the state pension funds from investing in this stuff.
Absolutely.
I
And
mean,
our
I think
401k.
one law I think one law should be that state pension funds have to buy liquid securities subject to transparency laws, disclosure laws.
We can pass that law. We should also say that private equity firms cannot practice healthcare.
Right.
The private equity firms shouldn't own healthcare. They shouldn't own emergency rooms. We know for a fact you've got a 42% higher chance of dying. That should be reason enough.
After the Stewart Hospital scandal, didn't one state put a limitation on private equity buying hospitals?
Yes, there are several states that are trying, and they're being sued by private equity firms to undo it. And Stewart and Prescott, both of these hospital systems had CEOs that rode off into the sunset with $300 million yachts, right? But what we have now are vast regions of the northeastern United States where rural areas now have no health care within 3 to 4 hours. And women have to take 4-hour rides to the hospital in labor. People are dying on the way to the hospital.
Right. So during the 90s, the early 90s, I was on the board of Sallie Mae. And I had run-ins with the leadership that wanted to privatize. And I felt their mission was not to make money. Their mission was to help kids get a great education. Anyway, after I left, they were instrumental in getting the laws passed so that kids couldn't write off their student loans in bankruptcy.
I'm embarrassed to say right after privatization, I went to work for USA Funds, one of their private arms. That was where I worked my first job. Yep. I worked for USA Funds on their Sallie Mae contract.
So what they did was they engineered the law so they could make money on kids failing.
Yeah.
They didn't need the kids to succeed. They could make money on kids failing. And I've researched a lot about what happened and who did it, et cetera. And it's clear to me that it was an intentional plan to simply extract and plunder the next generation. They knew what they were doing. It was intentional.
They were very effective in that effort. I actually just saw Jerome Powell advocate for making them bankruptable. He just advocated for that in a recent hearing in Congress. He said,
That's, thank God, it's 20 years, 30 years too late.
but when they took off the purse strings on professional degree allocations, that also gave a signal to the schools to start spending it. And what kills me is that they've raised their rates at insurmountable, like just massive, like metrics over inflation, right? The way that fees have gone up. When I was in college, my class used to cost me $284. Now at that same college,
Right.
it's like $2,400. It wasn't that long ago, right?
Right.
But when we see that they're doing this, we're also seeing that 67% of those increases are only going to bureaucracy and bloat.
Right.
67% of that spend is just salaries for people in the admin. They're not giving better teachers. You're not getting better facilities. You're not getting better education. You're getting more administrators, more bureaucracy.
Right. Yeah, and phony research.
Yes.
You're getting phony research that
Lots of
gives
phony
air
research.
cover to the private equity guys in government. Okay, so let's talk about investment, because one of the things I can do is I can stop investing in these companies and their funds. Okay? But it does mean if I'm if I'm locked into a company administered 401k, I've got to get active and make sure that the administrators know that that is not going to happen in my 401k.
Yes.
I mean, literally.
That has to be a huge promise that teams get together and make to one another to all advocate for that. And if you have a union, get your union rep advocating for that.
Absolutely.
Right? You should be galvanizing whatever worker protections you can to get your company as far away from private equity as you can with your retirement tools.
Right. That applies not only to your 401k, but to your insurance benefits and
Yes.
insurance. Because
Absolutely.
the other thing you need to do is you need to do due diligence on your insurance policies or annuities or any other deals you have with private insurance companies. And you need to make sure their credit is not leaving out the back door. Okay. And there are things you can do. You can contact the state insurance department and commissioner. I mean, there are many things you can do, but the other thing you can do is you cannot buy insurance or enter into an insurance policy with an insurance company that's owned by private equity or has too many backdoor deals with private equity.
I also recommend people turn away from anything that has an arbitration agreement. Strike it in the contract, sign it, and hand it back. If they don't notice, you're free, right? Strike it in contracts, move away from anything.
That is an excellent idea. And I'll tell you another thing you can
Lining
do.
it out, signing it, initial next to it, hand it back, and hope they never look at it. Get rid of it. Don't sign anything that has an arbitration agreement.
Right.
Whether it's an employment contract, a storage unit, a veterinary clinic, strike it out.
Ladies and gentlemen, always listen to someone who has an outward bound law degree. Okay, so the other thing you can do is your alma mater or charities you give to, if they're putting money into an endowment and putting money into private equity, you can make a huge. Why should you give money to a university that is financing this? Is financing the destruction of America? Seems to me a bad idea. The other thing is social life, right? Remember Liz Estrada? You don't need to date or associate with people who do this. I mean, I think making the people who do this highly socially unacceptable would be a major contribution.
Yeah, if you see them on the board at a museum that you used to support, start fighting back, send letters, post them publicly on their Facebook pages.
Right.
If you have a bunch of private equity investors or a bunch of private equity board members or general partners that are serving on nonprofits that are important to you, trying to whitewash their strip mining conduct through altruism, make a stink about it. Make sure the world knows. Right. If you see that somebody is in proximity to you in any social environment and anywhere you're looking that has made their fortune. JAB Holdings is a good example. This is a private equity firm that made all of their family money through the exploitation of concentration camp labor. And now they own Panera. And now they own like Insomnia Cookies and Krispy Kreme. We don't support them. They own Dr. Pepper and they own Keurig and Green Mountain Coffee. We don't support them because they made all their money on concentration camp labor. And when it came out publicly, they said, we're going to make a big donation. We're going to make a big donation to the Holocaust Museum. Now they found a list of 800 families they had exploited. And rather than paying restitution to those families they exploited to make all their wealth, they gave a $10 million donation to a museum, which represented 0.04% of their wealth. even though it all came from exploitation. So when you find these institutions that are engaging in unconscionable conduct or have come from a point of engagement of unconscionable conduct, you call it out, you boycott, you make it known, and you don't play ball.
So one of the things we have a place at Solari where called Connect, where people in the same place get together and share things, but it's a lot of work. It's inconvenient when you are going through the world and making sure you know, you're doing business with all these different businesses, and it's inconvenient to not go to the big grocery store, but find a rancher or farmer that you can trust. It's a lot of work to figure out, which doctors are okay or which vet clinics are okay. And I think there's a lot to be gained by teaming up.
Yeah, I agree with you.
Right. And I think we have to team up and share information. One of the things, I moved to Tennessee from Washington in 1998, and I had family in the neighborhood. And basically, that's the kind of place where you got to make sure you have the right plumber. You got to make sure you have the right, you got to, and my cousin just sat me down and said, okay, here's who you can trust in these 40 different categories, and I only went through, if it hadn't been for people that I could know and trust, telling me who I could trust in these different areas, I would have been in trouble. So there's a real need to organize and team up.
For food, I have a solution that could help people. There's actually a new app that just launched called Buyer, Buyr, and
Right.
it has
I
a
saw it.
scanning function that allows you to see whether the food you are trying to buy is private equity owned, major corporation or consolidation owned, or if it's from a family or founder owned brand.
Oh, great.
That one's new and I'm using it. I've been using it for the last 2 weeks and I love it. It's great.
Do you really?
Yeah.
Somebody recommended it to me, but I
like
haven't
it.
tried it. Okay.
Yeah, it's working. It's
Okay.
great.
Okay.
But we need more communication about this. You should be doing this in your community Facebook groups. If you find out that your veterinary clinic suddenly hikes the prices, and I ask the women at the desk, they're already scared for their jobs, they're already mad they were acquired, they will tell you.
Right.
Find out and post it very publicly to everyone.
Right.
It's what we have to do.
Right.
What we have to do.
So we all need, as we travel around the world doing transactions, we all need a private equity filter.
Yes.
It's that simple.
That's what we need.
Okay. Right. So there are lots of great businesses out there. There are lots of great people out there who you can do business with and trust. And that's what's so amazing. It's always shocking to me. I do a lot with banking, and I'm always shocked when people are complaining about the most hideous thing their big bank just did. And their big bank has been doing hideous things for decades, and they're still in the big hideous bank when there are wonderful community banks and credit unions that they could move to. And I'm like, why? It's almost like the Stockholm syndrome. Why are you tolerating this? You could have a wonderful relationship with a great bank. Why are you putting up with this?
We had a small bank around us that there's a few and I use one of them. There was a small bank called Sandy Springs and it just got bought up by Atlantic Union because people aren't using enough community banks and we're not keeping them safe and fiscally healthy. We need to be using these community banks to lose those community banks.
Right. You're going to lose them.
Yeah.
Okay. Well, we've certainly covered a lot of territory. I know there's more, but before we close, is there anything else you want to add that we haven't covered that I forgot?
I just like to finish by reminding people that someone has been hurt by the system. Every one of you knows somebody that's been hurt by this system, whether it's the arbitration system that hides the bad conduct of corporations or the private equity firms that exploit it and hurt your kids or the employees or the customers, right? You have to understand, you just don't know. Every single year in America, 1.6 million Americans are forced into secret courtrooms they're never allowed to tell you about. There's only 300 million of us here. So if you've been alive for 10 years, that means, a fair percentage of them, you know these people, you just don't know what's happening to them in the background. And so if we don't start pushing back, if we don't use the shoes we stand in right now to forfeit our convenience and maybe a small percentage of our capital to stop trying to save money at all costs, which I know is hard in this environment. I know it's hard. Right? But we have to give up our convenience and our capital in small numbers to support the small businesses in our town. They're the ones that sponsor sports teams. They're the ones that sponsor the kid with cancer down the block that needs a jar on the counter. They're the ones that are going to sponsor a Girl Scout troop. We're not seeing that. Every time a private equity firm acquires a business in your community, 94% of the money you give that company will leave your community and never come back. But if you support a small business in your community, A small business is going to keep 68 to 74 cents in your community. It stays in your town, right? So you have to start looking for those businesses. You have to support those businesses. And if you know somebody that's going through hell through a secret arbitration, be there for them, help them out, right? But know that you need to do everything you can to protect yourself from that secret court system.
And when you help them, use cash, because then
Yeah.
after 10 transactions, all the money hasn't left the community in fees.
Yes, absolutely use cash. Find those local farms, find those local small businesses, because every single sandwich chain has been acquired by private equity at this point. There's not one left, but there's a really great restaurant down the block for me called Pumpernickel and Rye, and that's where I go.
Yep.
I used to like Jersey Mike's. We tried to save them, and they ended up selling to Blackstone. You have to understand that almost everything
Right.
is gone. And so if it's a chain restaurant or has very strong intellectual property, a logo you recognize, you need to look away. You need to start supporting the small mom and pops that care about the people you live with.
You need to do business with companies who are trustworthy and
Yes.
have a demonstrated record of being trustworthy.
Seek out small medical practices, seek out small orthodontists, optometrists, right? You have to really do the work, but once you find them, stay there and tell everyone else about it. That's the
Well,
best
that's
thing
the
we can
thing.
do.
You can stay forever as long as
Yes.
they don't sell out. I
That's
mean,
right. And
some
as long as
do.
we keep bringing people, they won't.
Okay, now speaking of good things to do with your money, one of the things I've done is I've spent 11 years in highly expensive, very dangerous litigation. I know what it's like, and Tiffany is still litigating, and she's got a GoFundMe, and I would love for everybody to go support. And I would just say I believe every donation is a prayer. And so if you can't afford a lot, donate $1, donate $5, donate a little bit. The success of a donation campaign depends not just on lots of money, but lots of donors. The more donors who come in, the easier it is to bring in the people who can't afford money. So I would really ask that you consider giving a donation. It's Christmas time. It's the time to donate. I'm going to go, Tiffany, after this interview and make a donation. And I hope everybody else, if you can afford it, will do so. And also keep Tiffany and her efforts and her family in your prayers, because what she is doing with her litigation is making a contribution to all of us. And as she's done this litigation, she has researched and networked and dug out fantastic amounts of information, which is bringing tremendous transparency to what's going on. And it's made it possible. She and a few other people who've written some great books. We have reviews at Solari. Tiffany and their information is making it possible for me, people like me, to integrate, sort of what's going on in private equity with some of the other shenanigans going on in the financial system. And we're getting a very much more clear picture of what's going on. So this is somebody who's done enormous service for me, for the Solari team, and for all of us. And I would just ask that you consider including her in your holiday donations, because this is a great thing she's doing, and it's got a very high return for all of us. So, Tiffany, I can't thank you enough for joining us on the Solari Report. I can't thank you enough for doing what you're doing, and we're here if there's anything we can do to support you and help your efforts. I hope you will let us know.
It's been an honor to be here. I've really had such a good time, like just learning from you and collaborating and learning new things that I think impact my research too. And I hope you'll have me back.
Of course. Absolutely. As we always say at Solari, we're in cahoots.
I love it.
Ladies and gentlemen, you have a wonderful evening, and thank you for joining us on the Solari Report. Okay, well, ladies and gentlemen, Tiffany and I are back because we recorded several weeks ago. We're going to publish next week on January 6th, and so much has happened in the last 3 weeks. I would say the last 3 weeks in the private equity world is explosive, other than I think a lot of the media is catching up with you, Tiffany. That's what's explosive.
Yeah.
So let's just dive in. We're going to do a quick addendum to the interview we did to give you a taste of what's happened in the last 3 weeks. Okay, Tiffany, dive in. Tell us what's happened.
So, in addition to several sort of red flags that are coming out of the Fed and coming out of the banking regulators right now, that sort of send up warning signs that there's about to be a lot of need to get out of certain markets, what we see are a series of articles that have come out in the Financial Times, the Economic Times of India, the New York Times, that are all saying that they have identified a clear rot in private equity. I mean, who could have predicted, right? They've identified clear rot in private equity, and investors are very, very scared. And pensions, especially, are very, very scared, and rightfully so.
Right. So let me just put some numbers on this. So in 2025, we're recording on the first day of the year. So congratulations, welcome to 2026. In last year, private equity only sold 321 companies, and that's an all-time low. And they have something like what's the total portfolio? 17,000 companies?
Higher, I think. I think we're closer to 21, but they're not tracking the small firms.
Right. And so basically, they weren't able to get any exits. I mean, as a statistical matter, almost no exits in 2025, which means the whole portfolio is stuck.
But what they did get is $100 million of that 321 exits were to themselves.
Right.
They sold them to themselves. And that's what's really triggering all of these massive alarm bells right now. They also got the amazing honor of being responsible for 70% of all major bankruptcies in 2025.
Oh, wow.
Anything
So
over
that's
$1
a new
billion,
record.
it was private equity aligned.
Right. So, and we just saw Saks file yesterday.
Saks and then Sprinkles, which is one of the first big private equity exits that Shark Tank brags about all the time. They filed yesterday as well. They're gone. They closed all their stores this morning.
So how many bankruptcies from private equity have we seen since you and I spoke?
Oh, just in the last 2 weeks, over a dozen.
Over a dozen
with four majors.
And so now we have the entire industry basically not able to get exits.
Correct. They're sitting on almost $4 trillion in backlog right now.
So, but what they've been doing is trying to exit with each other. And as you said, that's not working. So now they've come up with something called the continuum funds. Explain what the continuum funds are.
Yeah. So when we first recorded, we talked about the danger of the secondaries market. That's swapping two businesses between two private equity firms that they can't off-sell. It's like we have to close out our fund. Another firm has to close out a fund. Neither of them can sell their assets, so they sell them to one another. They can't get a fair market value, so they inflate the value and they trade it. And that was called a pyramid scheme 3 years ago by the Financial Times. It's been called a pyramid scheme over and over again because they're just trading. There is no fair market valuation. Well, even those are now stuck. They won't trade with one another either. So they've each started doing something called a continuation fund. That's where, let's say I have ABC private equity and I own a company that I cannot sell, but my fund has to close out. My investors can start suing me if it doesn't. Okay.
Right.
And I need to collect my 2 and 20 fees, and I need to deliver on returns for these investors or we go belly up. And so what I do is instead of trying to continue selling it and making my investors mad, I create a new fund that's going to expire in 10 years. And I put new investors in that fund and I tell them I have the deal of a lifetime. And the new investors buy the business from my other fund. I sell it to myself. And I use that new money to pay out the investors from the first fund. It is a Ponzi scheme.
Right.
Period.
Now, why would the new investors come in?
Well, right now, what we're seeing, and if you look at the New York Times article I sent you this morning, the one that talks about the circular deals being the rotten private equity, what you're seeing is that a lot of them are pensions that can't take a loss. And so they have to go into the new fund to keep pushing their books out.
Oh.
Right? Their pensions.
Wow.
So they're about 50-50 right now.
I'm in the old fund and I'll come into the new fund so the old fund can close out and I can help keep the game going.
But they're also getting sued. The Saudi royal family, I think, is in one of the big lawsuits against, I think it might be Clear Lake. They're suing several funds right now that are doing this because they're saying they're sending different numbers to different investors. The fees associated with it are different for different investors. They're doing whatever it takes, and they're giving people 48 hours to decide whether to lose money or go into the new fund. And so they're suing, saying it's a self-enriching scheme. And it's happening in the Chancery Court in Delaware right now.
Wow.
Yeah.
Wow. There's something else too, because I've been reading reports from private equity firms, and one of the things they talk about is how they can create liquidity in addition to selling to each other, creating these funds, these new continuation
funds.
Continuation
Take
fund.
sellable assets and continue them into a new fund instead of closing out traditionally or IPOing.
Now they're talking about once the Clarity Act or the the Senate version is called, you're going to love this, Responsible Innovation Act.
Forgive me for
Once
spraining my eyeballs just now. I apologize.
so the responsible innovation, once that passes, they're talking about doing asset tokenization and using asset tokens to get liquidity on their existing portfolios.
They're running, I don't know a better way to explain it than they've run out of ways to cash out. Like every single vehicle they've used isn't working. And so now it's just whoever can come up with the newest thing that's not illegal yet.
So there's an old saying on the street, he who panics first panics best. And Harvard and Yale marked down their portfolios and have been marketing them. I don't know how much they've sold, but they clearly followed the panic first rule because they were and particularly Yale was the big leader in.
They had a 30-year head start on private equity.
Right. So has that message gotten out to the pension funds? And what are the pension funds saying and doing?
I think it's more than just Harvard and Yale getting out to the pension funds because there are pension funds invested with Harvard and Yale, right?
Right.
But they definitely $8 billion in liquidation of their private equity holdings was definitely a huge warning bell. Absolutely. But what we're seeing right now is that one of the biggest booms for pension investment in private equity happened between 2015 and 2019. There was a huge boom in pension investment in private equity. And right now, what we're seeing right now is all of them are coming up on the closing of their funds. And the thing that pensions love about private equity is that for 10 years, they get to keep whatever the estimated gains are going to be on their books. They don't have to give quarterly updates. Whatever they said they were going to make, they get to keep on those books for that full decade. And it looks like they're all shored up. The states don't get involved. The regulators don't get involved. Everything looks peachy keen. But what we're looking at right now is thousands of these funds about to close out from this boom period of pension investment.
Right.
And they're not closing. They're sitting on so many, on billions and billions and then trillions of dollars in unsellable assets. Okay. 19,000 stuck companies they can't sell right now. 19,000, right?
Right.
The pensions can't close out and they're about to have a reckoning. And so if they don't pour into these continuation funds, they're going to have to acknowledge what's happened. And if the private equity firms don't pay out to the original funds, they're going to lose pension investment across the board, right? So they have no choice but to find liquidity, and they're doing it through really nefarious means. And not one of those means involves taking a hit to their own balance sheet because they're getting fees on both funds now.
Right.
For not succeeding, for failing.
So I want to bring up two parallel developments. First of all, I just finished reading a very thoughtful and well done local investigative piece on the supposed Somali fraud in Minnesota.
Yeah.
And it looks like a remarkable amount of the facilities were these autism centers. And according to one of the reports I read when we did our first interview, that has been a particular area of the private equity firm is rolling up the autism service centers.
So there are more than 100 private equity firms I've identified that are explicitly focusing on education and healthcare and where they intersect. A really good example actually is Platinum Equity. I just did a huge story on Platinum Equity. It went viral on every channel on Platinum Equity because they were rolling up what I call the childcare to education to prison pipeline. And they own prison services and school services, and they're buying everything in between. And actually, I think they might be the ones getting sued by the royal family. I have to rethink. I think that they might be the ones getting sued. They're at the heart of one of the big lawsuits that's just happening right now, and they've had several bankruptcies roll out of their investments. But what's happening is that they're finding that when you don't have a really good diagnostic capacity for quantifying things, you can exploit just about any amount of money out of the government through lots of different mechanisms. And yes, autism centers are at the heart of several of these private equity roll-up strategies.
Right. So I don't know. I think there's a story there. I'd love to see somebody go after that. So that's number one. Number two, what is now coming out because the economy is slowing is that for many years, many municipalities, it's both at a county level and a state level, have been doing off-balance sheet bonds that now have the risk is coming that they're going to have to be moved on balance sheet, or the defaults are going to have a ramification for the formal balance sheet. So at the same time that the state pension funds are getting hit by private equity, you're going to see the municipalities get hit by the off balance sheet debt. At the same time, if the valuations and performance of the pension funds go down, many times their payments for the pension funds are going to go up.
We'll see a ton of mentions this week in rumblings everywhere on social media about bonds in the silver market as well.
Right.
And I've seen that silver got really close to its call line for a bunch of corporations and banks this week, and that they had an emergency late night meeting on, I think it was Christmas Eve, where they got together to sell.
Yeah, there's a very high paper to collateral ratio in the silver markets, and it's squeezing a lot of people now.
I think we're facing, I think this year is going to be terrible. I don't like saying it. I want to come in a positive note. We still have time to do stuff.
So I'm a great believer. If I have to live through another year where they keep all these lies floating along, I mean, the worst part about this, Tiffany, is not the fraud. The worst part of this is you create an economy where everybody stops being productive.
Yeah.
And they invest a huge amount of time in being unproductive. So you had a business that was helping kids grow up and be strong and successful, right?
Yes.
And they just wreaked havoc with that. Okay.
Yes.
Now translate that by millions of different businesses and people throughout the economy. You literally reward the unproductive and destroy the productive. Okay. And if we're going to get back to anything productive, this needs to unwind. It needs to collapse. It needs to hit a wall. So I don't know. It's like an infection rising the surface and draining. My attitude is I let it blow. I'm happy.
The New York Times got it right when they said it's a rot and it has to be cut out. It has to fall.
Yes.
And one of the biggest things that I've been advocating for the last several years is that we've gotten so good at giving socialism to corporations while allowing people to bear the downstream penalties of capitalism.
Right.
Right. We've gotten exceptionally good at socialism for corporations and banks.
I don't think this is socialism. I think this is organized crime.
No, I agree with you.
I really do.
I agree
think
with
it's
you.
organized. And if you look at the tactics they're using, I think they're using organized crime tactics.
I agree with you. It is cartel-like, RICO-like conduct across the board.
Right.
What I worry about is that if we're not very, very vocal in not allowing our pensions to bail them out and not allowing our 401ks to bail them out, if we're not very, very vocal with our government, and I'm going to be frank right now, I can already tell you what's going to happen in the midterms. We're going to see a big shift. Big shift. Right. If we're not very vocal with the people that are about to ask for our votes, if we're not out in force, then what we're going to see is a whole bunch more socialism for corporations.
Right.
Nothing's going to change. We're going to kick the can down the road.
I think you have so Trump has passed or has adopted an executive order encouraging the 401ks to pick up the private equity. I don't think you wait for November. I think you roll into your 401k administrator now and you say absolutely no way. I just think, we need to push back in the private markets hard and fast. We need to say to our financial planners or investment advisors or our discount broker or our 401k administrator, we need to start screaming. If Harvard or Yale, if I was an alum and they asked me for money, I would say not on your life.
Yep.
You're basically giving my money to criminals and destroying my world.
Yeah. When we first recorded the episode, I mentioned that people have known for a long time that you weren't winning the American way through private equity. We knew it when we saw the movie Pretty Woman back in the 90s, right? We knew it.
Right.
We knew it. He was a bad guy when he was breaking up companies and extracting wealth and selling them off for pieces. We knew it. He was a good guy when he was building American excellence, building ships, doing things.
Right.
He was a good guy, right? We have known this for a very long time, but we haven't known how to do anything about it. And there are things we can do right now. These are things we can do right now.
Right. Well, you start by protecting yourself. And as you protect yourself, you stop feeding the parasite.
Yes.
Right. So I just do want to mention one of the top stories we have, we're about to record our annual wrap up this Saturday. One of the top stories, somebody very experienced naval person just published an article talking about the fact that the Navy is no longer the superior Navy and is basically falling apart. You know, and that ties back to what's going on in private equity and the fact that we're busy extracting capital instead of building great ships.
Yeah.
Now,
really
here's why I say the whole game that the private equity floats on is having the reserve currency. If you don't have a good Navy, you're going to lose the reserve currency. That's how you lose a reserve currency. So, you know, you can't, the parasite can destroy the host, and that is what is happening.
Yeah.
Yeah. Anyway, so an exciting 2 weeks, and we're going to publish this next week, and I have a feeling the excitement is not going to stop. So remind everybody again how they keep up with you. You're on X.
I'm on X, and as the Vino Mom, I'm on TikTok as Tiffany Cianci, and I have tiffanycianci.com. You can keep up with me everywhere.
And when you publish interviews, when you do public interviews, do you put them up on your TikTok and X?
I do. I take clips because you can't publish the whole thing there, and I do publish most of my interviews at tiffanycianci.com.
Okay. Okay. Well, ladies and gentlemen, this is going to be a very exciting year in 2026 in private equity. And I think that Tiffany's, you definitely want to plug into what she's up to, because I think you're going to be covering it all year long. It's going to keep you quite busy. You're going to have a very exciting year, Tiffany. Anyway, I can't thank you enough for what you're doing. And thank you again for coming and doing this addendum. It was when I saw the sex bankruptcy, I said, oh, here it comes.
Here it comes.
Here it
And
comes.
we're watching right now. I think we're going to get, for unfortunately, the largest bankruptcy year for private equity on record. And we've had that 4 years in a row. But we have so many funds that have to close out, and there's so much debt out there. I just don't see it any other way.
Right. Do you have any sense for the funds that have to close out this year? Who are the biggest pension fund holders? Do you have any guess at all?
I think CalPERS started pulling back this year because they saw their risk. CalPERS had over invested, but we're seeing it in the Oregon teachers funds. We're seeing it in several of the states. Washington has a lot in there. Nevada has an immense amount in their teachers funds. We're seeing it in a lot of public works sector funds. All of the, I hate to say it, all of the pension funds went over on private equity about 8 years ago, and they've started scaling in the last 2 years. But that's because those funds are not performing the way they expected.
I was shocked. I went to look at, I think it was CalPERS or CalSTRS. I was surprised at how little liquidity they had. It was scary.
Nothing. They're all tied up. And that's why they started pulling back. But I will say, they almost went the other direction. And that's because they had one anti-private equity board member on CalPERS, and he was forced out by Newsom. And he replaced him with a pro-private equity guy. And then they saw the returns, and even all the private equity people pulled back because they saw how dangerous it was. And even then, that's when I knew all hell was about to break loose, for sure.
So my guess is that, I just want to come back to this, that the municipalities have no idea that they could suddenly see their pension fund bills skyrocket.
I think they're about to. And I think the next years are going to be really hard for the pension funds. I think we're going to see, well, we saw in the article I sent you from the first recording, we saw a pension fund that got a shortfall on their private equity returns so bad that they had to let go of 6,700 teachers. 6,700 teachers without jobs.
Right, we talked about that.
That is a warning. That's a canary. That's not something that's an outlier. That's what we're about to witness.
So here's the thing. When you organize your economy to build billionaires instead of building wealth, this is what you get.
Yep.
Yep.
You're absolutely right.
We get billionaires and a lot of poverty.
Yeah.
Okay. Tiffany Cianci, you're great. Have a wonderful day. Thank you for joining us on the Solari Report, and I look forward to being in cahoots with you in 2026.
Me too.
Ladies and gentlemen, welcome to 2026. It's going to be a corker.